Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about something that sounds super complicated but really doesn't have to be, the stock market. You hear about it all the time, right? Well, today we're going to pull back the curtain, demystify the whole thing, and give you the confidence to actually understand what's going on. Let's dive in. So, when you think about the stock market, what comes to mind? A bunch of people in suits on Wall Street yelling into phones? A lot of us think it's some kind of exclusive club. But is it? No way. It's actually a powerful tool that's out there for everyone, and I'm going to show you how you can be a part of it. So here's our game plan. First up, we'll figure out what a stock even is. Then we'll peek under the hood to see how the market works. After that, we get practical with a getting started checklist. And to wrap it all up, we'll talk about how to avoid those classic rookie mistakes. Sound good? Okay, first things first. What is a stock? I mean, really. To get the answer, we've got to go way back. We're not starting in New York. We're starting on the open ocean hundreds of years ago. It's a story that goes from epic trading voyages all the way to that little app on your phone. Okay, picture this. It's the year 1602. You want to fund this massive globe-spanning trade voyage. The problem? It's ridiculously expensive and super risky. Way too much for any one person to handle. So the Dutch East India Company comes up with this genius idea. They thought, hey, what if we sell little pieces of the voyage, we'll call them shares, to lots of different people. That way the risk is spread out and they get the cash they need. That one idea, it was a complete game changer. It grew from there, with traders meeting in London coffee houses, and eventually it led to the foundation of the New York Stock Exchange we all know today. So when you boil it all down, what's a stock? It's just proof that you own a tiny piece of a company. The best way to think about it is like a giant pizza. The company is the whole pie, and when you buy a stock, you're just buying one slice. That makes you a shareholder. And that's not just a fancy word, it means you are literally a part owner. You get to share in the profits. But yeah, you also share in the risks. All right, part two. We know what a stock is, but how does the whole market actually work? Let's follow the money from a company's big idea right into an investor's portfolio. You can think of the market like a big ecosystem with a few key players. First, you've got the companies. They need money, capital, to grow, to invent new things. To get that cash, they turn to player number two, investment banks. These are the folks who manage the whole process of going public. Then you've got the stockbrokers. They're the middlemen, the platforms that let us regular people trade. And finally, there's us, the investors. We're the ones buying ownership in those companies. Okay, so how does a stock get from the company to you? It's a journey. Step one, a company decides to go public with an IPO. This is called the primary market. The company sells its brand new shares directly to the first batch of investors. Think of it like a car company selling a brand new car straight from the factory. But what happens next? Well, those shares then hit the secondary market. That's the stock exchange you always hear about. Here, investors just trade those shares with each other. The company's not really involved anymore. It's just like people selling that same car, but now it's used back and forth. And the price? It's all about supply and demand. Simple as that. Okay, theory's great, but let's get practical. Section 3 is all about getting started. And listen, before you even think about putting a single dollar into the market, we need to go through a checklist. These 4 things are absolutely essential. All right, here's your pre-flight checklist. First, know your why. What are your goals? Are you trying to build wealth for the long haul, save for retirement? Your goal is everything. It determines your whole strategy. Second, you've got to get your own finances straight. Know what's coming in, what's going out, and what debt you have. Third, and I can't stress this enough, this is non-negotiable, you need an emergency fund. That's your financial safety net. It stops you from having to sell at the worst possible time if life throws you a curveball. And only then, once you've checked those 3 boxes, should you even start looking for a stockbroker. Now, I want to share something really important. The quote says, "The worst mistake that you can do when starting out in the stock market is quitting your job." Now, why is that so critical? Look, it's easy to get excited, to think you're going to get rich quick. But you are going to make mistakes. Everybody does. Learning this stuff takes time. Having that steady paycheck from your job takes all the pressure off. It lets you learn, it lets you be patient, without betting your entire financial future. And that brings us perfectly into our last section, how to avoid the classic rookie mistakes. Seriously, just knowing what these traps are is half the battle. This is all about protecting your hard-earned money when you're just getting your feet wet. Mistake number one, and this is the big one, making decisions based on your emotions. It's a total roller coaster, right? When the market is flying high, you get that FOMO, fear of missing out, and you just want to buy, buy, buy. Then when it drops, pure panic kicks in, and the urge is to sell everything. The key to successful investing is having a plan and a cool head, so you can just tune out all that daily noise and hype. All right, mistake number two, forgetting to diversify. You've heard this a million times, but it's true. Don't put all your eggs in one basket. It's just common sense. If you throw all your money into one single company and that company hits a rough patch, well, you could lose a lot. Spreading your money out is just a basic, fundamental way to keep your risk in check. And the third big trap is trying to time the market. You know, that fantasy of perfectly predicting the bottom to buy and the top to sell. Here's the truth. Nobody can do this consistently, not even the pros. Trying to do it just turns investing into gambling. A much, much better approach? Just invest steadily over a long period of time, and don't worry about the day-to-day craziness. So really, it all boils down to this one question. Are you an investor or are you a gambler? Your goal is to be an investor. An investor is a part owner of a business. You're focused on that company's long-term health and growth. A gambler, on the other hand, is just betting on the squiggly lines on a chart, driven by hype and emotion. Making that mental shift from gambler to investor, that is everything. And there you have it, the stock market. Hopefully a little less mysterious. We figured out what a stock is, how the whole system works, and most importantly, how to get started on the right foot by avoiding those newbie traps. Just remember, this isn't some secret club. It's a tool, one that's available to you. Every big journey starts with one small step. So the real question is, what's your first steps going to be? The stock market. You hear about it all the time, right? It's this giant, powerful thing that creates billionaires and fuels incredible innovation. But for a lot of us, it's still kind of a mystery. Well, today, we're going to pull back that curtain. We're going to find out where this whole idea came from, and more importantly, how it shapes our world every single day. Let's dive in. So let me start with a question for you. How did a London coffee house change the world? I know, it sounds like the beginning of a bad joke, but the answer is actually the key to understanding all of modern finance. That one coffee shop was the birthplace of an idea that would go on to fund empires, spark world-changing inventions, and basically build the world we're all living in today. Let's connect the dots. So, here's our game plan. First, we're going to go way back in time, starting with ships on the high seas. Then, we'll nail down the most important piece of the puzzle, what a stock actually is. After that, we'll look at how the modern market really works, and then we'll wrap it all up by figuring out why this idea from hundreds of years ago is still so incredibly important today. To really truly get the stock market, we need to hop in a time machine and go back a few hundred years. You know, this wasn't some idea cooked up in a fancy boardroom. It was a super practical solution to a massive, and I mean massive, risky problem. Okay, imagine for a second you're a merchant hundreds of years ago. You've got this brilliant, game-changing idea for a trading voyage to the other side of the planet. It can make you unbelievably rich, but it's also incredibly expensive and risky. We're talking ships, a crew, supplies. It's way, way more money than any one person could possibly have. So what do? That was the big problem. Well, the solution was just genius in how simple it was. Don't go it alone, right? Instead of one person taking on all the cost and all the risk, groups of investors started pooling their money together into what they called joint stock companies. This idea of shared risk and shared reward, which the Dutch really perfected, completely changed everything. It made these huge, world-spanning adventures possible for the very first time. And this brilliant idea took off and evolved, and it did it fast. In 1602, you have the Dutch East India Company issuing the first ever paper share, like a physical receipt for your piece of the pie that you could actually sell to someone else. The idea spread like wildfire. By 1773, traders in London, who had just been meeting informally in a coffee house, went ahead and bought the building, and, you guessed it, called it the stock exchange. And just a couple decades after that, the idea jumped across the Atlantic. 24 brokers met under a buttonwood tree in New York and created the foundation for what would eventually become the New York Stock Exchange. So this idea of shares was officially born. But what exactly is a stock? When you buy one, what are you actually buying? At its absolute core, a stock is just a certificate of ownership. It's way simpler than it sounds. Think of a company as one giant pizza. When you buy a stock, you're not just lending the company some cash. No, you're buying a tiny slice of that pizza. You literally become a part owner. You're a shareholder. Let's make it even more concrete. Imagine 100 people get together to start a new business. If every single person chips in the exact same amount of money, then each one of them now owns exactly 1% of that new company. A stock is basically the official piece of paper that proves you own that 1%. It's really that straightforward. But, and this is a big but, not all slices of the pizza are created equal. As you can see here, stocks get classified in different ways, and maybe the most important difference comes down to voting rights. See, some shares give you one vote in big company decisions. Others, sometimes called multi-right stocks, can give certain owners way more power, more votes per share. And then some shares come with no voting rights at all. It's a really key detail to remember. Owning a piece of the company doesn't always mean you get an equal say. Okay, so a stock is a piece of a company. Got it. But how do these little pieces get bought and sold by millions and millions of people every single day? Well, that's where the modern marketplace, the modern arena, comes into play. In today's market, you've basically got three major players on the field. You've got the investment banks. Think of them like the party planners who organize a company's big debut on the market. Then you've got the stockbrokers, who are the intermediaries, the ones who actually handle all the buying and selling. And, of course, you have investors, which is everyone from huge, massive funds to regular people like you and me. So, a stock's journey usually starts with something called an IPO, or initial public offering. A private company wants to get bigger, so it decides to raise a bunch of money by selling off pieces of ownership to the public. To do this, they hire an investment bank. That bank does all the homework to figure out a fair price for the shares. And then, for the very first time, those shares are sold on the open market. But that IPO, that's just the launch party. The real day-to-day action happens afterward, on what's called the secondary market. This is what you think of when you hear New York Stock Exchange. It's where investors, using their stockbrokers, buy and sell shares from each other. This constant buying and selling, that's the real heartbeat of the stock market. Now, once all these shares are out there in the wild, not everyone plays the game the same way. People come at buying and selling with totally different strategies and, totally different timelines. Okay, so let me be super clear. This is not investment advice, but it helps to know the lingo. You have short-term trading, which is buying and selling over just days or weeks. It usually takes a lot of experience. A market order is the most basic move. You just tell your broker to buy or sell at whatever the best price is right now. Then there's swing trading, a strategy that focuses on catching those short-term price swings over a few days. Every approach has its own goals and definitely its own risks. All right, we've covered the history, the concepts, the mechanics, but the big question is, why should we even care? Let's zoom out for a second and look at the real big picture here. I think this quote just absolutely nails it. The stock market isn't just a bunch of numbers blinking on a screen. It's the engine that literally funds progress. It's the whole system that connects ambitious ideas with the money they need to actually become a reality. So when you put it all together, you really see the market's true impact. It takes our collective resources and uses them to fund everything from the next huge startup to small improvements in the products we use every day. It helps power the entire economy, and on a personal level, it gives individuals a really powerful tool for building their own long-term wealth. And that really brings us right back to where we started. Just think about it. If those merchants never figured out how to pool their money, if that little coffee house never became an exchange, what incredible ideas would have been lost to time? What would our world even look like today? It's a powerful thing to think about, and it's a reminder of how a simple concept, shared risk for shared reward, truly changed everything. Thanks for joining me on this explainer.
So you're thinking about diving into the stock market. I get it. It can feel like this huge, intimidating world, full of jargon and charts that just look scary. But what if I told you that getting started is actually way simpler than you think? We're going to break it all down step by step and turn all that confusion into a really clear roadmap. Let's get into it.
I mean, at the end of the day, this is what it's all about, right? This is the dream. The idea that you can plant a little seed and watch it grow into something bigger. We all want our hard-earned money to finally start working for us, building a future that gives us a little more freedom, a little more possibility.
But yeah, that's the big question, isn't it? Where do you even start? It feels like you're standing at the bottom of a giant mountain of information. But hey, the good news, we're not going to try to climb the whole thing at once. We're going to start with the most important part, the foundation you absolutely need to build before you even think about investing your first dollar.
Honestly, this is where so many people trip up. They get excited and jump straight into picking stocks. But the real secret to success in the long run, and just as important to sleeping well at night, it isn't about picking some magical winning stock. Nope. It's about getting your own financial house in order first.
Let's think of it like a pre-flight checklist. Seriously, you wouldn't just hop in a plane and take off without knowing your destination, would you? Of course not. That's step one, your goals. You also need to make sure the plane is in good shape, right? That means getting a clear picture of your finances. And you absolutely 100% need a parachute, just in case. That's your emergency fund. These three things, they are totally non-negotiable.
So, what's the actual mission here? Are you trying to build a rocket ship to get rich super fast, or are you planting a big oak tree that's going to provide shade for decades to come? Because the strategy for each of those is completely different. Trying to replace your income is going to require some pretty risky, high-frequency trading. Building a retirement fund, on the other hand, is a slow, steady journey. You just have to be really honest with yourself about which path you're actually on.
And this quote, wow, it just hits the nail on the head. It is so tempting to dream about quitting your 9-to-5 after your first little win. But that's steady income. That's your safety net. It's what allows you to make all those rookie mistakes, and trust me, you will make them, without it leading to financial ruin. It basically buys you time to learn under pressure, but not desperate pressure.
All right, so your financial foundation is solid. Now, it's time to open up the toolbox. See, you can't just walk onto the floor of the stock exchange yourself. You need a special key to get in, and that key is your stockbroker. But here's the thing you gotta know. Not all keys open the same doors.
When you start looking for a broker, it is so easy to get lost in all the details. But for a beginner, there are two things that matter way more than anything else. First, is my money going to be safe? Make sure they're regulated and insured. And second, what kind of educational resources do they have? A broker that actually teaches you how to fish is way more valuable than one that just sells you a cheap fishing rod.
This chart really boils it down to one simple trade-off: cost versus support. An online broker is going to be cheap, but you are the pilot, the co-pilot, and the navigator all at once. A full-service broker, though, gives you a professional co-pilot, but they're going to take a bigger cut of the profits for it. The right choice really just depends on how confident you are flying solo. So, you've done your homework, you've picked your broker, and you're ready to go. You see a stock you want to buy, you type in how many shares you want, and you click that big green buy button. But what actually happens in the milliseconds after you click? Let's follow the money and find out. Okay, before we go any further, let's just quickly decode a bit of Wall Street jargon, the lot. The easiest way to think of it is like buying eggs. You can sometimes buy a single egg, but they usually come in a carton, right? A lot is just the stock market's version of that carton, and it's typically 100 shares. It's just a standard unit for trading. That's all.
And here it is, the entire journey of a trade, which, by the way, happens in the blink of an eye. 1, you place your order. 2, your broker acts like your agent and zaps it over to the market. 3, the market's high-speed matchmaking system finds someone who's selling what you want to buy. And 4, the trade is done. The shares land in your account and the cash leaves. It's basically a high-speed digital handshake.
Okay, so now you know how to buy a stock. But the much bigger question is, what's your game plan? What's your strategy? Are you going to be a solo adventurer? Do you want to hire an expert guide, or do you team up with a whole group of explorers? Let's take a look at the 3 main paths you can take.
So, as we saw a little earlier, this is the classic choice. On one side, you've got the do-it-yourself path. You're in complete control, which feels great, but it also means you are responsible for every single decision, the good and the bad. On the other side, you can hire an expert. This gives you a nice safety net of professional advice, but it comes at a cost, both in fees and, well, in giving up some of that control. But what if there was a third option? And this is that third way, the investment club. Think of it as social investing. Instead of going it alone or paying a pro, you team up with friends or colleagues. You pool your money, sure, but more importantly, you pool your brain power. You get to debate ideas, share research, and learn together. It's kind of like a book club, but for building wealth. It's an absolutely incredible way to lower the cost and the fear factor.
Okay, you've got your foundation set, you've chosen your path. Now for the million-dollar question. What do you actually look for in a company? The key isn't to chase hype or some get-rich-quick scheme. It's about learning to think like a real investor, and that means you've got to learn to look under the hood.
A smart investor looks at 3 key layers. First, the big picture. How's the overall economy doing? A rising tide lifts all boats. Second, what's the company's story? Does its growth look like a steady climb up a mountain, or is it more like a terrifying roller coaster? You want stability. And finally, you check the balance sheet. Is the company standing on a solid foundation, or is it getting weighed down by a huge pile of debt?
And that last point about debt, it is so important. Think of it this way. If a company is buried under a mountain of debt that it can't pay off, that's a massive red flag. Why? Because in a worst-case scenario, the company has to sell everything it owns to pay its lenders first. And as a shareholder, you are last in line, which often means you get left with absolutely nothing.
And that really brings us to the most important takeaway of all. Stocks will go up and stocks will go down. Strategies are going to change. The one asset you own that will never, ever lose its value is what's between your ears, your knowledge. That's your true wealth. So the journey doesn't end here. The real question is, what will you learn next? Thanks for tuning in.
Ever feel like picking a winning stock is like trying to find a needle in a haystack? Yeah. But what if you had a map? Well, in this explainer, that's exactly what we're going to give you. Let's dive in. I mean, it's the big question, isn't it? You've got thousands of public companies out there, from huge tech giants to tiny little startups. So where do you even begin your search? It's easy to feel totally overwhelmed. Right. It's like there's hidden treasure out there, but finding it, that feels like this huge, almost impossible task. You're basically on a quest, but, a quest is pretty tough without the right tools. And that is our promise to you right now. We're going to hand you that map by breaking down all the essential clues, the tools, and the sources you need to find those really promising companies. All right, so let's get this quest started. The goal here isn't to just chase the latest hype. No, it's about looking past all that noise to find companies with really strong, healthy fundamentals, the ones that show real promise. It all comes down to understanding the value of what you're actually buying. Every single company has a financial story to tell, and you just need to know how to read it. These metrics we're about to cover, they're the clues. They're what will help you decode that story and see what's really going on with a company's health. Okay, first up, revenue. The easiest way to think about this is it's the total sales number, all the money coming in the door. Now, here's what's really key for investors. You're not just looking for a big, flashy number. What you really want to see is a steady, year-after-year increase. That's the sign of consistent growth. Next up, we have net earnings. This is the profit, right? The money that's left over after all the bills are paid. But here's a super important point. A low net earning isn't automatically a bad thing. Not at all. A company could be pouring money into innovation or restructuring, which might lower profits now for a way bigger payoff down the road. And this right here, this just nails the difference perfectly. Revenue is what they call the top line on an income statement. It's all the money coming in. But net earnings, that's the famous bottom line. It's what's actually left. Two totally different but equally crucial pieces of the puzzle. All right, now for a big one, the PE ratio, or price to earnings. A lot of experts will tell you this is a main indicator of a stock's value. What it basically tells you is how much investors are willing to pay for every single dollar of a company's earnings. So, how does it actually work? Let's make this super simple. Imagine a company earns $2 per share, and let's say its stock is trading at $20 a share. You just divide that 20 by 2, boom, you get a PE ratio of 10. That tells you that investors are willing to pay $10 for every $1 that company earns. Simple as that. Okay, our next clue to investigate is return on equity, or ROE. This one is all about efficiency. It's asking a really important question. How good is this company at using its investors' money to make even more money? Now, this is absolutely crucial. Generally speaking, a higher ROE is better. It shows the company is efficient, but, and this is a big but, context is everything. You can't compare a tech company to a utility company. You've got to compare apples to apples. A company with a consistently high ROE compared to its direct competitors, now that is often a fantastic sign of great management and a real competitive edge. And look, the investigation doesn't stop there. This is just the start. You'll also want to dig into a company's debt, check out its own forecasts for the future, though, take those with a grain of salt. And of course, you have to see what the competition is up to. A really thorough quest means leaving no stone unturned. Okay, so you know what clues to look for, but where do you actually find them? Let's pull out the treasure map and look at the reliable sources where you can get the real, hard facts. So here are your go-to spots. The company's own investor relations website is always a great place to start. Then you've got financial sites like Yahoo Finance, Google Finance, and Morningstar. They're all essential. But if you want the purest, most unvarnished data, the SEC's website is your ultimate source of truth.
Yeah, see, public companies have to file these reports with the SEC. The 10K, that's the big one. It's an annual, fully audited report on the company's health. The 10Q is kind of its unaudited quarterly cousin. And then there's the 8K. That gets filed whenever something major happens, whether it's good or bad.
You know, I absolutely love this quote because it is so true. These documents are not flashy marketing brochures. They're intentionally dry, they're factual, and that is exactly why they are a smart investor's best friend. There's no spin, just the data.
Now, I get it. Decoding all this information can feel like a huge task. But thankfully, you don't have to do it all by hand anymore. Modern investors have a really powerful toolkit at their fingertips. And the hero of this toolkit has to be the stock screener. This kind of software is an incredible time saver. Seriously, you just plug in the criteria we've been talking about, like a certain PE ratio or debt level, and it instantly filters through the entire market to give you a custom list of stocks that fit your exact needs. It's a game changer.
So what about financial analysts? I mean, there are a lot of opinions out there, right? The key is to separate the helpful ones from the just noisy ones. The best thing to do is find a few analysts you really respect, whose values align with yours, and use their insights as a way to kind of check your own research and your own gut instincts. All right, so we've covered the clues, we've got the map, and we've got the tools. Let's put it all together into a clear plan of action so you can finally begin your journey. Here it is, your official Investor's Quest checklist. First, decode those financial clues, the metrics. Second, use your treasure maps, like the SEC filings. Third, make sure you wield your toolkit, like stock screeners. And finally, and this is a big one, always compare a company to its peers in the same industry.
So here's the bottom line. Just jumping into the market without doing the work, that's basically just gambling. But it doesn't have to be that way. A proper investigation is your absolute best defense, and now you have a solid framework to get started.
So you are officially equipped for the quest. You've got the map, you've got the tools, and you know exactly what clues to look for. The only question left is, what hidden treasure are you going to uncover first? Happy hunting!
Have you ever glanced at the stock market tickers and just seen, well, a total mess of flashing green and red numbers? It can feel pretty chaotic, but what if I told you that you can actually learn to read those numbers, almost like you're reading a story? Well, today, we're going to do just that. We're going to demystify stock prices and break down exactly what makes them go up and down. And trust me, by the end of this, that chaos is going to start to make a whole lot of sense.
So, this is the million-dollar question, right? How can a stock be worth one price right now and then a totally different price just a blink of an eye later? Now, look, it's impossible to pinpoint the reason for every single little tick, but the basic principles behind it all, they're actually surprisingly easy to get your head around, and that's exactly what we're about to unpack. Okay, so before we can figure out why prices change, we kind of have to know where they come from in the first place. It all kicks off at the very start of a stock's public life, where one simple, super powerful rule gets set in stone, and that rule governs its price forever. So a company's big debut on the stock market is called an initial public offering, or you've probably heard of it as an IPO. This is the moment a private company decides to go public, selling its shares to people like you and me for the very first time. Investment banks help figure out a starting price, and this all happens on what's called the primary market. But that's really just the launch pad. The real day-to-day excitement happens next, on the secondary market.
And there it is. That's the secret sauce. Once those shares are out there on the open market, every single little price change, every up, every down, every single day, it all comes down to this one classic economic idea, the constant tug-of-war between supply and demand. So how does this tug-of-war actually work? Well, it plays out between two numbers, the bid price and the ask price. Think of the bid as demand. It's the absolute highest price a buyer, somewhere out there, is willing to pay for a share right now. And the ask, that represents supply. It's the lowest price a seller is willing to part with their share for. A trade only happens when a buyer and seller agree on a price, and that's what makes the stock price move.
Okay, so if supply and demand is the engine driving the car, what's the fuel? What makes thousands of people suddenly wake up and decide, I want to buy that stock, which pushes demand up? Or what makes them all rush to sell it, which cranks up the supply? Turns out there are a few major forces at play. It pretty much boils down to these three big things. First, just how well is the company itself doing? Second, what are the big fish, the huge investment firms, up to? And third, what's the general vibe of the entire economy? Let's quickly break them down. First up, company performance. This is huge. If a company puts out an earnings report saying they made record profits, you can bet a lot more people are going to want to buy that stock. Next, institutional investors. We're talking about the giants here. Hedge funds, mutual funds, pension plans. When they decide to buy or sell millions of shares at once, their sheer size can literally move the price. And finally, you've got the overall market conditions. Things like big economic news or just general good or bad feelings in the economy can create a tide that honestly lifts or sinks all boats together.
And here's a perfect, if a little scary, example of that last point. Back in 2008, the financial crisis wasn't about one single company failing. It was this huge wave of fear and bad news that just washed over the entire market, pulling almost everything down with it. It just goes to show you how powerful that overall economic mood can be.
All right, we've talked about the why, the big forces that push and pull on prices. So now, let's get practical and learn the actual language of the market. When you look up a stock online, you see this stream of numbers and symbols. Let's decode what they're all trying to tell you about that whole supply and demand story.
First thing you'll notice is you don't see long names like the Coca-Cola Company. You just see KO. Every public company gets a unique ticker symbol. It's basically a nickname that lets traders and websites pack a ton of information into a tiny space. Next, you'll see a high and a low. This is super simple. It just tells you the stock's price range for today. Think of it as the highest peak the price reached and the lowest valley it dropped into. It's a really quick snapshot of how wild of a ride the stock has had since the market opened.
The close is your starting line. It's the final price the stock settled at when the market closed yesterday. So every number you see today, every change, is all being measured against that one benchmark number.
And that brings us to the net change. Honestly, this is probably the number your eyes will jump to first. It answers that one simple question we all have. Is the stock up or down today, and by how much? It's just the current price minus yesterday's closing price. Simple as that. And to make it even easier, you don't even have to do the math. The net change is almost always color-coded. You see green, you know the stock's having a good day, it's up from yesterday's close. You see red, you know it's down. It's a universal, at-a-glance language for how the stock is doing right now.
Okay, now let's zoom out a bit. The 52-week high and low give you a much, much bigger picture. Instead of just showing you today's little journey, this tells you the absolute highest and lowest prices the stock has hit over the entire last year. It gives you some really valuable context on its long-term story.
And yeah, in case you were wondering if 52-week was some kind of complicated Wall Street code, it's not. It's just 52 weeks in a year. It's a standard way of looking at a stock's performance over one full calendar year.
And finally, we've got volume. This number tells you exactly how many shares have been bought and sold today. If the volume is super high, it means there's a ton of interest and activity. A lot of people are talking about and trading this stock. Low volume, it's just a quieter day. It's a great little indicator of how much buzz is surrounding a stock.
All right, we've covered the forces that move the market, and we've learned the language that describes those moves. So now, let's connect all of those dots and put everything together into one clear picture.
And really, this is it. This is the whole story in one sentence. It all starts with those market forces, the news, the economy, company performance. That stuff influences demand, whether people want to buy or sell. That demand shows up in the volume, how many shares are traded. All that trading activity is what drives the price up or down. And how do we measure it all at a glance? With the net change. It's a perfect chain reaction, from a news headline all the way to a single number on your screen.
So, from now on, when you look at a stock quote, you're not going to see just a bunch of random numbers anymore. You're going to see the end result of a massive global conversation about what a company is worth. You now have the basic tools to start listening in on that conversation. So the real question is, what stories are you going to see the market telling?
Ever feel like the stock market is this exclusive club with a secret handshake you just don't know? Well, we're here to change that. In this explainer, we're going to cut right through all the jargon and give you the straightforward, simple fundamentals of buying and selling stocks. So let's jump right in.
First things first, let's get one huge thing out of the way: the fear of messing up. Because here's the reality. Perfection is a myth in investing. This quote says it all, Even the absolute pros get it wrong sometimes. The goal isn't to be perfect. It's to be prepared and to keep learning.
And that's exactly what we're here to give you, a map. We're going to lay out the foundational knowledge you need so you can navigate those first steps with real confidence.
Okay, first up, let's talk about getting into the right frame of mind. Because investing, it's not some get-rich-quick scheme. It truly is a long-term journey. It's all about patience and strategy, not about high-speed gambles.
This is such a critical mindset shift. Instead of getting obsessed with how one single stock is doing day to day, successful investors are looking at the big picture, their entire portfolio. They're thinking in years, not in minutes. And hey, when one investment doesn't work out, they learn from it and they move on. They don't let it wreck their entire long-term plan.
All right, mindset? Check. Now let's get into the nitty-gritty. How in the world do you actually decide which companies to invest in? Well, it's all about moving past those gut feelings and getting into real analysis.
So how do you do that? I mean, we've all heard of the big names, right? It's so tempting to just think, oh, that's a good company, I'll buy some stock. And sure, that can work out sometimes. But a much, much safer strategy is to actually dig into the facts. That means looking at a company's financial health. We're talking revenue, assets, cash flow, to really understand its true value.
And one of the most powerful tools for doing this is something called the price-to-earnings ratio, or just PE ratio. Put simply, it helps you figure out if a stock's price is high or low compared to how much profit the company is actually making. It's like a quick check to see if a stock might be a bargain.
So here's how you can think about it. A company with a really high PE ratio might be overvalued, meaning its stock price might be a little too expensive for its earnings. But a company that has strong financials and a low PE ratio, now that could be a signal that you're looking at a stock that's basically on sale, a potential hidden gem. Now, a quick but super important warning. You're going to hear these wild stories about penny stocks, these super cheap shares that supposedly made someone rich overnight. The truth is, while that's technically possible, it is incredibly rare and unbelievably risky. For most of us, these are just best avoided. So, you've done your homework, you've picked a stock you believe in. Fantastic. Now for the practical part. How do you, actually buy it? Let's walk through the exact steps. You can't just buy stocks directly from a company. You need a gateway to the market, and that gateway is called a broker. Think of them as the authorized company that connects you to the whole stock exchange. And thankfully, this is pretty much all online now. You find a broker you trust, you open an account, put some funds in it, and boom, you're ready to go. Okay, when you go to buy, you've basically got two main choices. A market order is you telling your broker, get me this stock right now and I'll pay whatever the going rate is. It's all about speed. A limit order is more like saying, hey, I want this stock, but I'm only willing to pay up to this specific price. That one is all about control.
So there's a trade-off, and you got to remember it. With a market order, you are pretty much guaranteed to get that stock almost instantly, but the price might fluctuate a little. With a limit order, you are guaranteed to get the price you want, but if the stock never drops to that price, well, your order might just sit there and never go through.
So, now that we get the mechanics of buying just one stock, let's zoom back out. Let's talk about building a whole collection of them, what we call your portfolio. And this brings us to one of the oldest and probably the wisest sayings in the entire world of investing. The idea of putting every single dollar you have into just one company, well, it's incredibly risky. And there's a very simple reason why. Let's make this feel real for a second. Imagine all of your savings were invested in just one company. Let's say Boeing. Now, what happens if some totally unexpected negative event occurs? Suddenly, that one single stock could plummet, and it would take your entire investment down with it. The solution to this scary risk has a name. It's called diversification. It just means that instead of putting all your eggs in one basket, you spread your investment across lots of different baskets. So different companies in different industries like tech, healthcare, finance. That way, if one industry has a rough year, another one might have a great one, and it all helps balance things out. And how you decide to diversify really depends on your own personal goals. If you're younger, just starting your career, you might focus more on aggressive growth. You're trying to build wealth over decades. But if you're a retiree, the focus shifts completely. It's more about preserving the wealth you've already got and maybe generating a steady income. Your portfolio should be a reflection of your life.
All right, for our final section, let's add two really powerful methods of analysis to your investor's toolkit. Think of these as the two main lenses that investors use to look at every potential buy. So on one hand, you have what's called fundamental analysis. This is the detective work we talked about earlier, digging into a company's real health, its finances, its leadership, its place in the market. This is the long-term investor's game. On the other hand, you've got technical analysis. This is way more popular with short-term traders, and it's all about reading the charts, using past price patterns to try and predict what's going to happen next.
The key takeaway here isn't to pick a side, it's about seeing the value in both. Think of it like this. Fundamental analysis helps you figure out what to buy, a healthy, strong company. And technical analysis can help you figure out when to buy, when the timing and trends look good. Using both just gives you a massive advantage. So, we've covered the mindset, the research, the mechanics, and the big picture strategy. We've put the basic tools right into your hands. I guess the only question left is, what are you going to build with them? You know, investing can feel like this high-stakes game, right? So how do you make the right moves to actually win? Well, today, we're going to break down some essential investment strategies to help you build your very own playbook for your financial future.
All right, so let's just jump right in with the million-dollar question. How do you win in the stock market? I mean, seriously, is the secret to try and find that one superstar stock, you know, that one amazing player, and just bet everything on them? Or is there maybe another way to play? A way where you bet on the whole team at once?
You know that whole idea of betting on the entire team? That leads us perfectly into our first major concept. It's a hugely popular strategy, and it's called index investing. Let's really dig into its power. So, what in the world is index investing? Well, think of it this way. It's a strategy where you just stop trying to pick individual winning stocks. Seriously. Instead, you diversify your money across hundreds, maybe even thousands of them all at once. The goal here is actually pretty simple, but it's incredibly powerful. You want your investments to basically mirror the performance of an entire stock exchange. So, you're not trying to outsmart the market, you're literally becoming the market. But why is this approach so popular, especially with the experts? Well, honestly, the data is just crystal clear. Study after study has shown that for most people, index investing actually performs better than trying to actively pick stocks. And this is especially true over the long term. A huge reason for this is, well, it's just really hard for any one person to consistently beat the collective wisdom of the entire market. Plus, the fees are usually way lower, which means more of your money stays invested and working for you. Okay, so how do you actually do this? Well, you use investment tools you've probably heard of before, like mutual funds and exchange-traded funds, or ETFs for short. Just think of them as these pre-packaged baskets of stocks. They're designed to track a big market index like the S&P 500. So when you buy just one share of that fund, boom, you instantly own a tiny piece of every single company in that basket. But, and you knew there was a but coming, right? No single strategy is a silver bullet. It's just not that easy. So what happens when the economic tide goes out? Let's talk about the flip side of the coin and really get into the inherent risk that comes with this whole approach. See, index investing, just like any other strategy, has its sweet spot. It really thrives in a very specific environment, when interest rates are low. Think about it. Low rates make it super cheap for companies to borrow money and expand. And what does that lead to? Bigger profits. And bigger profits? Well, that boosts stock prices and lifts the entire market right along with it. And this right here, this shows you the market's two faces perfectly. During a bullish period, right? The economy's strong, interest rates are low, everything's looking up. The whole market tends to rise, and your index fund does great. But what happens if the economy tanks? Well, the exact opposite is true. Because you own the whole market, you're also exposed to the whole market's downturn. When things go south, all those stocks are likely to take a pretty big beating.
So, here's the crucial point, the main takeaway from all this. Relying on just one strategy, even one as powerful as index investing, can leave you really vulnerable. To build a portfolio that's truly resilient, one that can take a punch, the smart move is to combine strategies. This could mean adding things that behave differently from stocks, like bonds or real estate. The idea is to create more stability and give your portfolio a cushion for when the stock market inevitably hits those rough patches.
Okay, so let's get to our final section and see how all this comes together into an actual plan. It's time to talk about building your personal playbook, because that right there is the real path to long-term success. Look, investing isn't some one-time decision. It's a journey. First, you gotta try things out, experiment with different approaches, and just see how they work in the real world. Then, you discover what's right for you. You use that experience to figure out what actually suits your personal goals and, really importantly, your comfort level with risk. Third, you have to oversee it all. This is not a set it and forget it kind of deal. You have to actively monitor how your investments are doing. And finally, and this is so key, you have to evolve. Your strategy has to grow and change right along with your life and the markets. And let me be super clear about this. Your investment strategy is going to change. It has to. Your goals, your life, the market, everything is constantly shifting. Adjusting your approach isn't a sign that you failed. No way. It's the sign of a smart, engaged investor. In fact, it's exactly what every successful investor does. So, if change is the only thing we can count on, how do you manage it? Well, the solution is definitely not to find one perfect strategy and just cling to it for dear life. The real key is to focus on overseeing your investment approach. That just means you're paying attention, you're understanding how your portfolio is being affected by what's happening in the market, and you're making smart adjustments along the way.
And that brings us to the final thought here. We've established that your strategy will change and that it should change. That's a given. So the real question this leaves us with is a big one. Are you ready to change with it? Because at the end of the day, being an adaptable, informed, and engaged investor, well, that is the ultimate strategy for building real, lasting success. Welcome to The Explainer. Today, we're cracking open the Trader's Toolbox to demystify a really crucial concept, one that helps investors cut through all that market noise. We're talking about technical indicators.
So it's the million-dollar question, right? Every single trader asks this when they're staring at a stock chart. Is it all just a gut feeling, a roll of the dice, or is there actually a smarter way to play this game?
Well, it's definitely not about guessing. For a lot of traders, the real goal is to make an educated forecast by, trying to predict the market's next move.
And to do that, they use this whole arsenal of tools designed to analyze historical data. The idea is pretty simple, actually. Past price movements, trading volume, all those market patterns, they can give you hints about what's coming next. It's kind of part math, part psychology, because think about it. When millions of traders are all watching the same signals, their actions can pretty much create a self-fulfilling prophecy.
So let's go ahead and open up that toolbox and see what's actually inside. What are these essential tools that traders are relying on, every single day?
They're called technical indicators, and at their core, they're just mathematical formulas. They take a stock's past data, like its price and how much of it was traded, and they turn all that raw information into these clean visual cues right on a trading chart.
Now, these indicators usually fall into two main families. First, you've got overlays, which get drawn right on top of the price chart itself, so they interact directly with all the price action. And then you have oscillators. These guys get their own special window, usually just below the main chart.
But here's a really crucial warning that comes from our source material. While there are literally thousands of indicators out there, more is definitely not better. Trying to use too many at once, that just leads to what's called analysis paralysis. You're so overwhelmed with conflicting signals that you just can't make a decision at all. You freeze up.
So, with that warning in mind, let's meet a few of the most popular and, honestly, foundational indicators that you're going to find in pretty much every trader's toolbox.
First up, a true classic trend indicator, the moving average. Its main job is super simple but incredibly powerful. It's designed to smooth out all those chaotic day-to-day price swings and help you see the underlying direction of the market trend way more clearly.
See those smooth, flowing lines drawn right over the price bars? Yeah, those are moving averages. They just give you a much cleaner view of where the trend is generally headed. A lot of traders will watch the 50-day average for the short to medium-term trend, and then they'll look at the 200-day average to get a feel for the long-term health and direction of a stock. Okay, so if moving averages tell you the direction of the trend, our next tool measures its energy. It's a momentum indicator called the Relative Strength Index, or RSI for short, and it's all about the speed and the strength of price movements.
The RSI is an oscillator, which means it lives in its own box below the price chart. What it does is it measures the strength of recent price changes on a simple scale from 1 to 100. Its primary job? To alert traders when a stock might be overbought or oversold, which is often a big heads-up that a price reversal could be just around the corner.
And to do that, it uses two really critical levels that traders watch like a hawk. And those key numbers are 70 and 30.
So here's how it works. When the RSI reading climbs up above 70, it's a signal that the stock might be overbought. Maybe the enthusiasm got a little ahead of itself and the price could be due for a downward turn. On the flip side, when the RSI drops below 30, it signals the stock might be oversold, that maybe the selling has been overdone and it could be ready for an upward bounce.
All right, so we've looked at trend and momentum. That tells you where the market is going and how fast it's getting there. But a lot of traders believe there's a third absolutely essential piece you need to confirm if a move is for real, and that's volume.
This quote from our source really just nails it. Think of volume as the amount of participation behind a price move. I mean, if a stock's price is soaring, but only a tiny number of shares are being traded, that's a huge red flag. A strong, healthy trend gets confirmed by high volume. It shows conviction. It tells you that the big players are driving the move, not just a few small-time speculators. It's the fuel in the engine.
So, we've just looked at some really powerful tools, but maybe the single biggest takeaway from all this isn't about any one indicator. It's about the power of simplicity. Remember that warning we talked about analysis paralysis? Well, the practical advice for anyone starting out is crystal clear. Don't clutter up your charts with a dozen conflicting lines. Just start by mastering, say, 2 to 5 indicators that really make sense to you and that fit your personal trading style.
So what are the big takeaways here? First, the whole point of indicators is to simplify your analysis, not make it more complicated. A great place to start is by combining different types of indicators, maybe one for trend and one for momentum, so you get a fuller picture. And ultimately, it's all about just experimenting and finding a strategy and a set of tools that truly fits you.
In the end, it's so important to remember that technical indicators are not a crystal ball. They don't predict the future with 100% certainty. What they are is an incredible framework for helping you read and understand the present market conditions with way more clarity. So, after this quick tour of the toolbox, what are you going to look for first?
All right, welcome. Over the next few minutes, we're going to demystify something absolutely fundamental to our modern economy, the stock exchange. Have you ever really stopped to wonder where stocks are actually bought and sold? It's not just some abstract thing you hear about on the news, right? Nope. It's a real, super organized marketplace, a place where fortunes can be made and, honestly, where economic trends are born. So let's pull back the curtain and really see how this thing works. So, at its heart, a stock exchange is really just a specialized marketplace. But, and this is a big but, don't let that simple definition fool you. It's run with some really strict rules. And as we're about to see, it has 2 absolutely critical jobs that are, you could say, the lifeblood of our entire economy. And here they are, those 2 big jobs. First up, you've got the primary market. Now, this is where a company goes public for the very first time. They sell their shares to raise a whole bunch of money for, growth and new ideas. Then you've got the secondary market, and that's where you and I come in. It's where we trade those shares with each other. So, to put it simply, one market is all about raising capital, and the other is all about creating liquidity so you can actually buy and sell. Okay, so you might be thinking, why should I care about this if I'm not on Wall Street? Well, here's the thing. This whole engine, this marketplace, it's absolutely crucial for, well, pretty much everyone. Let's dig into exactly why that is. I mean, the impact is just massive. Think about it. Exchanges are what let companies get the cash they need to dream up new products and expand. They take the savings of millions of people, maybe even you, and channel that money directly into the productive parts of the economy. They even give regular investors like us a shot at owning a piece of the biggest companies in the world. And it's not just about corporations. Governments use them to fund huge projects, and those super strict rules, they force companies to be way more transparent with all of us. And that right there is the crucial point. All of this activity, the buying, the selling, the prices going up and down, it's like taking a real-time picture of a country's economic health, When the market's up, that usually signals confidence. When it's down, people are probably a little worried. It's basically the pulse of the entire economy. Okay, but how does a private company actually make that leap, right? How do they get their shares listed on one of these huge exchanges? It's definitely not as simple as just flipping a switch. It's a really demanding, super formalized journey.
The answer to that question is a complex but honestly fascinating process called an initial public offering. You've probably heard it called an IPO. This is that huge moment when a company goes from being privately owned to being traded out in the open on the public market.
And the road to an IPO? Well, it's a really intense step-by-step journey. I mean, a company has to hire investment banks, they have to register with powerful regulators like the SEC, and they have to prepare these incredibly detailed records on, well, everything. Their finances, all the potential risks. Then they have to go out and promote the IPO to get investors excited, get that final stamp of approval, and only then can they set a price and officially list their shares for sale. All right, so now that we've got the what's, the why, and the how, let's put some actual names and faces to all this. It's time to meet the biggest players on the world stage. So just to give you an idea of the sheer scale we are talking about here, just look at that number, 19.6 trillion. That's trillion with a T. Now, keep in mind, this figure is from 2016, but it just shows you the mind-boggling value of all the companies listed on just one exchange, the NYSE, at that point in time. That is an absolutely incredible concentration of capital. And you know what? The way trading actually happens has changed a lot. You've probably seen it in old movies, right? Those chaotic trading floors with traders shouting and waving their hands all over the place. That was called the open outcry system. But today, most exchanges are completely modern and digital. The trades happen silently at lightning speed through these massive computer networks. So here's a quick look at some of the global heavyweights. Again, this data is from 2016, but it gives us a really good sense of the relative size back then. And you can see just how long some of these have been around. I mean, the London Stock Exchange was founded way back in 1801. And then you've got the massive scale of the two big New York exchanges, the NYSE and NASDAQ. And this chart really paints a picture, doesn't it? It shows you just how dominant the top exchanges were back in 2016. Look at that. At that time, the New York Stock Exchange was more than double the size of its nearest competitor, NASDAQ. That really just hammers home its position as the global leader back then. But here's what's cool. Each of these giants has its own unique personality. You've got the NYSE, which is famous for its prestige and, believe it or not, still uses human specialists on that iconic trading floor. Then there's NASDAQ, which was basically born digital. It's been a fully electronic exchange from day one. And the Shanghai Exchange is a whole different animal. It actually operates as a nonprofit that's controlled by the government. So from now on, when you hear someone on the news say the market is up, you'll actually understand the incredible global system of capital, rules, and technology that's humming away behind that simple phrase. Which, of course, leaves us with one final thought to chew on. If the exchange really is the barometer for the economy, what is today's forecast telling you about what's just around the corner?
You know, if you've ever looked at the stock market and thought, this is just a giant casino, well, you are definitely not alone. But what if I told you there's a real strategy to manage all that chaos? Today, we are going to break down one of the most powerful tools any investor has, diversification. All right, let's jump right in.
I mean, you can picture it, right? The flashing lights, the sound of the slot machines, that feeling that it's all just random luck. And honestly, that feeling is what keeps a lot of people on the sidelines. But here's the thing. The market isn't just about luck. It's driven by real things that we can actually prepare for. And that real thing is what we call market volatility. It's the constant up and down, the swings that can make investing feel like a roller coaster. It's pretty much the one constant you can count on. So the real question is, how do you build a portfolio that doesn't just get tossed around by these waves, but actually learns to ride them? And here's the crucial part. It's not random. All this turbulence is caused by real-world events. So a smart investment strategy isn't about trying to avoid the storm, because you can't. It's about building a ship that's sturdy enough to sail right through it. So how do we do that? Well, it all starts with a piece of advice that's so common it's almost a cliché. But as you're about to see, that simple idea of not putting all your eggs in one basket, well, that's really just the tip of the iceberg. Yeah, we've all heard this one. It's like the first rule you learn in Investing 101. And look, it's not wrong. But real powerful diversification is so much more than just owning a bunch of different stuff. It's a deliberate, calculated strategy. Okay, now this is where it gets interesting. Look at the language here. It's about the careful selection of assets that are basically designed to be opposites. They react in different ways to the exact same event. So when one zigs, the other zags. That, right there, is the secret sauce. So let's just toss out that old basket metaphor for a second. Let's think about something more mechanical, something more interconnected. Let's talk about the cogwheel strategy. This is where you can really see it in action. Just picture the gears of a machine, right? As one gear turns down, its teeth catch the next one and push it up. Your portfolio should work exactly like that. The whole point is to create this smooth, stable motion, even when individual pieces are moving in completely opposite directions. And this example with oil and airlines is just perfect. Think about it for a second. When the price of oil goes through the roof, that's amazing news for oil companies. But for airlines, fuel is one of their biggest costs, so their profits get squeezed and their stocks often take a dive. And of course, the reverse is true. When oil is cheap, airlines thrive. See, if you own both, you've built a counterbalance right into your portfolio. Or how about another classic pair, stocks and bonds? When interest rates start to climb, that can often cool down the stock market. But at the same time, those higher rates can make newly issued bonds way more attractive to investors. They're like two sides of the same economic coin, designed to move in opposite directions. Okay, so this all sounds amazing, right? A perfectly balanced machine of a portfolio that can weather any storm. But like pretty much any strategy in life, there's no such thing as a free lunch. Diversification has some very real trade-offs, and it's super important that we understand both sides of it. So the biggest pro, obviously, is stability. It's your financial shield against the storm. But there's this other kind of hidden benefit that I think is fantastic. The act of diversifying itself forces you to stop and ask a really important question. How much risk am I actually comfortable with? And that kind of self-awareness, that's priceless. But of course, every shield has some weight to it. And the flip side of stability can sometimes be, well, average returns. By protecting yourself from the absolute worst losses, you might also be protecting yourself from the biggest, most spectacular gains. You could miss out on that one stock that just goes to the moon. And if you're not careful, you can get totally overwhelmed by all the choices, racking up fees every time you buy and sell. So really, it all boils down to this one fundamental trade-off. Diversification is, at its heart, a defensive play. You're basically paying a price, and that price is the potential for those massive home run gains in order to buy yourself some insurance against truly devastating losses. You're aiming to hit consistent singles and doubles instead of swinging for the fences every single time. So now that we know the good and the bad, what's the final call? How do we take everything we've talked about and actually use it in a smart, effective way? Which brings us to the million-dollar question. We've seen the pros, we've seen the cons. After all is said and done, is diversifying your portfolio actually worth the effort? And the answer, loud and clear, is absolutely yes. A well-thought-out, diversified portfolio is still one of your best tools for investing with confidence. See, the problems don't usually come from the strategy itself, but from how it's applied. So how do you find that perfect balance? Okay, first, don't go overboard. Owning hundreds of different things can just water down your returns to nothing. Second, you just can't eliminate every single risk out there, so don't drive yourself crazy trying to. And finally, you gotta find a management style that actually works for you. Something right in the middle of set it and forget it, and checking on it every 5 minutes. That's the sweet spot. So, let's go back to that first question. Is the market just a casino? Well, it's only a casino if you treat it like one. When you have a smart diversification strategy, you're not just pulling a lever and hoping you get lucky. You're an engineer. You're building a machine that's designed to last for the long haul. The only question left is, what kind of story will you build? Okay, so you're ready to start investing in stocks. You've got the drive, you've probably even got a few companies in mind. But then you hit that first big wall. Where do you actually go to buy them? You know, it's that one simple question that stops so many people right in their tracks. Well, that's what we're going to break down today. We've all seen images just like this one, right? The classic bull versus the bear. This idea of a market that's always in motion. It's exciting stuff, for sure, but let's be real, it can also feel pretty intimidating. The ambition to invest is there, but turning that ambition into actual action, that requires a clear, simple way to get started. And really, that's the question at the heart of it all. You've made the decision to take the leap, but the how can be a huge hurdle. Before you even get to thinking about fancy strategies, you got to figure out, where do I even go to open an account? So let's get right into it. When you're starting out, you've basically got two main paths to choose from.
First up, we have what I like to call the guided tour, and this is the route you take when you go through an online bank. For most people dipping their toes in for the first time, this is often the most straightforward and supportive option out there. Think of this path as having a built-in safety net. Going with a bank is usually the easiest way to start because honestly, they handle all the tricky technical stuff for you. Your buy and sell orders are all managed, the transactions are supervised by official market folks, and you can often get professional advice. That's a huge comfort when you're just finding your footing. Now, to make this work, you can't just use your regular old checking account. You'll need to open a specific type of account, usually called a securities account. The easiest way to think about it is like a special wallet that you need inside the bank just for holding your stocks. But all that guidance and convenience, it's not free. There's a trade-off, and that trade-off is the cost. Banks charge commissions on your transactions, and while it can vary, that fee can go as high as 4%. That's kind of the price you pay for having that helping hand. Okay, so what's the alternative? Well, that brings us to path number 2, the DIY adventure. This is for the investor who wants to be a bit more hands-on, and you do this using an online broker. With a broker, you are totally in the driver's seat. You decide exactly what to buy, exactly what to sell, and the costs are usually quite a bit lower. So what's the catch? Well, there's no one holding your hand. You're flying solo. Brokers also offer different trading tools. And one of the most common ones, which is very different from just buying a stock, is something called a CFD. So what in the world is a CFD? Well, it stands for Contract for Difference. And here's the key. Instead of actually buying a piece of a company, you're making a contract with the broker. It's basically a bet on whether you think that share's price is going to go up or down. Because of this, it's a much more complex tool that can magnify your gains, but also magnify your losses, which makes it way riskier than simply owning a stock. Okay, this is a big one. Both of these paths are going to cost you something, but how they charge you is totally different. To really make the right choice for you, you've got to understand how these services actually make their money. So let's break it down. All right, here's the key difference. With a bank, the cost is upfront and obvious. It's like a price tag. You pay a specific fee called a brokerage expense every time you buy or sell. With an online broker using things like CFDs, the cost is a little more hidden in plain sight. It's called the spread, and it's a tiny difference between the real market price and the price the broker gives you. The main takeaway here is that the broker is definitely still getting paid. Their fee is just collected in a more subtle way. For instance, if a stock's real price is $100, they might offer to sell it to you for $100.02, and then buy it back from you for $99.98. And that little 4-cent gap, that's the spread. That's their profit. It sounds like peanuts, but believe me, it adds up fast. So, there you have it. The guided tour with a bank, or the DIY adventure with a broker. You are officially at the crossroads. So, how do you decide which path is the right one for you? So how do you choose? Well, it really just comes down to asking yourself a few key questions. First, how confident do you feel in your own knowledge right now? Second, how much advice or support do you think you're going to need? And third, how sensitive are you to transaction costs? Is every penny a big deal? Generally, if you're new to all this and you value that guidance, a bank is a fantastic place to start. But if you're feeling confident, you're independent, and you're really focused on keeping costs down, then a broker might be a better fit. At the end of the day, there's no single right answer for everybody. There's only the right answer for you. You now know the 2 main doors into the stock market, you know what's behind each one, and you know what it costs to walk through. So the only question left is, which door will you choose to begin your journey? Hello and welcome. Today, we're diving into what feels like a real-life quest, understanding one of the most dynamic, fast-paced markets on the entire planet, Forex. So let's jump right in and see what it takes to get started in this world. First, just take a look at this number, $5 trillion. That's the absolutely staggering amount of money that's traded in the Forex market every single day. This shows you this isn't just a side hobby for some people. For many, it's a very serious path to building revenue. That sheer scale alone is what makes this world so fascinating. Okay, so what exactly is Forex trading? This is our first stop on the quest, and it's all about understanding the fundamentals of what we're actually doing here. At its very core, Forex is basically this giant global exchange where you're speculating on the changing values of different world currencies.
The entire journey from total beginner to active trader can really be broken down into 3 main stages. First, you gotta learn the basics, then you open an account, and finally, you start to trade. You know, before you can navigate any new world, you have to understand the language. It's just a fact. And Forex is no different. So let's get comfortable with some of the essential terminology. So every trade involves 2 currencies, and we call that a pair. Let's take the EUR/USD pair as an example, the euro versus the US dollar. The first currency, the euro, is the base, and the second one, the dollar, is the quote. The exchange rate just tells you how much of the quote currency, in this case US dollars, it takes to buy one single unit of the base currency, which is the euro. So if you buy the EUR/USD pair, you're buying euros and selling dollars. Simple as that. And for every currency pair, you'll always see 2 prices. You need to know both. The bid is the price a broker is willing to pay you for the base currency, and the ask is the price they'll sell it to you for. That tiny little difference between those 2 prices, that's called the spread, and it's basically how brokers make their money. So when you're looking at a quote, just remember this super simple rule. The bid price is always on the left, and the ask price is always on the right. This just means you sell at the price on the left and you buy at the price on the right. It's a fundamental thing you're going to see on every single trading platform out there. So how do you actually track your success? Or your losses? You use something called pips. Think of a pip like a penny is to $1, but for currency pairs. It's the smallest unit of change in a pair's value, and it's exactly how you measure your profits and losses on any given trade. It's a tiny number that can make a huge, huge difference. Okay, now that we know the language, the next part of our quest is figuring out what to trade. This is where you get to be a bit of an economic detective, kind of reading the map of the global economy. This is the million-dollar question, isn't it? And it's not random. It's not a guessing game. Your decisions should be based on reading the signs and trying to predict how a country's economy might perform. And the first signs are always in the numbers. Strong economic reports, we're talking high income, low unemployment, inflation that's under control, all that good stuff can boost a currency's value. But on the flip side, if an economy seems to be declining, traders might start to sell off that currency, causing its value to drop. And you can't ignore politics. Politics plays a huge role. A stable political climate is really attractive to investors. If a new government comes in with an agenda that has favorable fiscal policies or maybe loosens up some regulations to encourage growth, well, that can lead to a really significant increase in that country's currency value. And finally, take a look at what the country actually sells to the rest of the world. A country with high exports and goods that are always in demand is bringing in a lot of foreign money. And that strengthens its own economy, which, you guessed it, boosts its currency. Now, you're not on this quest alone. You need a guide, a partner. And in the Forex world, that's your broker. Choosing the right one is absolutely critical. I can't stress that enough. So this is where you have to do your homework. Look for a broker with at least 10 years of experience. That's a good sign. But most importantly, make sure they're regulated by a major oversight body. That gives you some reassurance about their transparency and honesty. After that, check out their website, read reviews with a critical eye, and really understand all of their transaction costs. So once you've found a broker you trust, you'll typically have 2 main choices. A personal account, which means you are in complete control of every single trade you make. Or a managed account, where you basically hire the broker to execute trades for you, all based on a strategy you both agree on. All right, you've done the learning, you've done the preparation. Now it is time to take that very first step and actually place a trade. This is where all that theory meets practice. But first, you analyze. You can use technical analysis, which is all about looking at charts and historical data to try and predict future movements. You can use fundamental analysis, which is what we were just talking about, looking at all those economic and political factors. Or you can use sentimental analysis, which is more about gauging the overall mood of the market. Okay, next, you place an order. A market order is the simplest. It's you telling your broker, trade right now at whatever the current price is. A limit order is way more precise. You set a specific price you're willing to buy or sell at, and the trade only happens if the market hits that exact number. And then there's the stop order, which is a really crucial tool. You can use it to enter a trade once a certain price is passed, or more commonly, to automatically get you out of a trade to limit your potential losses if the market suddenly moves against you. Whew, we've covered a lot of ground on this quest. But before you go, there is one final, absolutely crucial piece of wisdom that every single trader, beginner or pro, needs to hear.
This might be the single most important lesson of all. The market is volatile. It will go up and it will go down, sometimes in really dramatic ways. The biggest enemy of any trader isn't the market itself, it's your own unchecked emotions.
So, the takeaway here is this: be firm. Create a strategy based on your analysis and then have the discipline to stick with it. Because if you are confident in your plan, that's what's going to enable you to navigate the ups and downs and, hopefully, see profits over the long term. You now have the map, you know the language, and you have the fundamental tools. The rest of the journey, well, that's up to you. So the only question left to ask is, are you ready?
Today, we're going to tackle one of the biggest things that holds people back from investing: risk. We're going to break down what it really is, where it comes from, and, most importantly, how you can tame it.
Okay, let's just get right into it by asking a question I'm sure you've thought about. A lot of people feel like putting money into stocks is basically just a fancy trip to the casino. But is that really the case?
Well, to answer that, we first need to be clear on what we're talking about. Stock market risk, at its core, is super simple. It's just the possibility that you could lose money because a stock's price goes down. That's it. The real key here isn't trying to avoid this possibility altogether, but learning how to manage it.
So here's our game plan for this explainer. We'll look at the different kinds of risk you'll face. We'll unpack the huge trade-off between risk and reward, cover some killer strategies, and finally, point out some common mistakes so you can sidestep them. The whole point is to turn that feeling of fear into a feeling of control. All right, first things first. Let's take this big, kind of scary idea of risk and chop it up into smaller, much more manageable pieces. Because once you know where the risk is coming from, you can actually start to do something about it.
Now, this first one might surprise you because it's not out there in the market. It's right here inside our own heads. It's the risk of our own emotions.
I mean, think about it. Fear can cause you to panic and sell at the absolute worst moment. And on the flip side, greed can make you chase some hot stock right before it tanks. There's even a name for this. Psychologists call it loss aversion. Basically, the pain of losing $100 feels twice as bad as the joy of gaining $100. When it's your real money on the line, these feelings are incredibly powerful.
Okay, so beyond what's going on in our own minds, there are these huge, big picture risks. Forces that are completely out of your control. Look, the economy breathes. It has ups and it has downs. The market pretty much follows that pattern. Big crashes like the one back in 1987 are just part of the deal. They're gonna happen. You can't stop them. But what you can control is how you react. And history shows that for investors who stay patient, these downturns are often followed by really good times and can even be fantastic opportunities to buy. And, in the world we live in today, everything is connected. So what happens in the halls of power can ripple through your portfolio in the blink of an eye. A new regulation, a big international event, heck, even a single tweet from the right person can send a stock soaring or tanking. It's kind of wild. You don't have to be a political junkie, but being an informed investor means you got to pay attention to this stuff. Okay, so we've identified the main types of risk. Now, let's get to what is, without a doubt, the single most important concept in all of investing. If you only remember one thing, make it this. This right here, this is it. It's the fundamental trade-off. It's a simple, universal law. If you want the chance for higher returns, you absolutely have to be willing to accept a higher level of risk. There's just no such thing as a free lunch in investing. Let me paint you a picture to make this real. Imagine it's 1998. You take $10,000 and you invest it in this risky little online bookseller that's trying to compete against giants like Borders. All your friends probably think you're nuts.
So what happens to that crazy bet? Well, today, that $10,000 investment would be worth over $1 million.
That company, of course, was Amazon. And it is the perfect illustration of this trade-off. Back then, it was a massive risk, but that huge risk of failure was matched by the potential for an incredible world-changing success. And the investors who were willing to take on that risk were rewarded, well, handsomely is an understatement.
So you see, the point isn't to avoid risk, because that just means you're avoiding returns too. It's about managing it smartly. So let's look at a couple of time-tested strategies to help you build your armor.
The first tool in your toolbox is this beautifully simple technique that's all about taking your emotions completely out of the equation. It's called dollar cost averaging.
So how does this work? It's simple.
Let's say you invest $100 every month, no matter what. In month 1, the stock's at $10, so your $100 gets you 10 shares. Cool. Month 2, the price jumps to $20. Your $100 only gets you 5 shares. But then in month 3, the price drops to $5. Now that same $100 buys you a whopping 20 shares. See what just happened? You automatically bought more shares when the price was low. Your average cost ends up being lower than the average price. You're basically turning the market's ups and downs into your advantage.
All right, the next core strategy is diversification. And you've definitely heard this saying before, don't put all your eggs in one basket. That is literally all this is. By spreading your money across different companies and even different industries, you're making sure that if one of your investments takes a nosedive, it doesn't sink your whole ship.
Okay, finally, let's talk about the action plan. Knowing what not to do is sometimes just as powerful as knowing what to do. So let's cover a few common traps that you can easily sidestep right from the beginning.
The first big mistake is refusing to admit you are wrong. This is the hope trap. You have a stock that's going down, and you just hope it'll magically come back. The smart move is having an exit strategy, like a stop loss. You decide beforehand, if this stock drops to X price, I'm selling. It's about cutting your losses and moving on.
Here's another one. Thinking that a cheap stock is automatically a good deal. It's so tempting to see a stock that costs, say, $1 and think, what a bargain. But you have to ask yourself why it's so cheap. Usually there's a reason, and it's not a good one. A cheap stock with no momentum is just, well, it's just cheap.
And finally, lose the crystal ball. Seriously, stop trying to predict the future. Those complicated-looking charts are great for showing you what already happened. They can't tell you what's going to happen tomorrow. It's often a much better strategy to just identify the market's overall trend and ride that wave.
So, what's the big takeaway here? Risk in the stock market is going to happen, but it is also controllable. It's not some monster hiding under your bed. It's a puzzle. And the key isn't to get rid of it, but to understand it, to manage it, and to make it work for you. So the real question isn't how to avoid risk, it's what's the first piece of your puzzle you're going to put in place.
You know, the stock market can feel like it's got this total split personality, right? One day everything's up, the next it feels like it's all falling apart. So in this explainer, we're going to pull back the curtain on the two big opposing forces that are really behind all of these moves. Let's get right into it.
So, what's the deal with all this animal talk? A bull? A bear? What on earth does that have to do with your bank account? It's a great question. And trust me, by the time we're done here, you'll know exactly what they mean and how to handle the financial wilderness they represent. All right, let's kick things off with the main event, the big showdown between the two fundamental states of the market. Getting a handle on this dynamic is really the first big step to feeling a whole lot more confident as an investor. Okay, this slide just lays it all out so perfectly. Think of it like two totally different moods. On one side, you've got the bull. That's all about optimism, right? The economy's booming, investors are feeling good, and stock prices are generally heading up, up, up. And then you have the bear, which is the complete opposite. Pessimism kicks in, the economy's slowing down, confidence just vanishes, and that pulls prices right down with it. So let's zoom in on the bull for a second. A bull market is that awesome period of growth we all love to see. It's when it feels like everything's going right. Companies are doing well, the future looks bright, and people are excited to invest. All that good energy creates this powerful upward momentum, what everyone calls a bull run. And then there's the bear. This is the other side of that coin. When the economy starts to struggle and things look uncertain, investors get scared. They start selling off their stocks. That lack of confidence fuels a downward spiral. And just so you know, a bear market is officially defined as a drop of 20% or more from recent highs. It's a pretty significant, sustained downturn. Now, all this up and down might seem totally random and chaotic, but it's really not. It's all part of a predictable rhythm. The key thing to remember is that this isn't some battle to be won or lost. It's more like an endless dance between the bulls and the bears. Let's take a look at how this plays out for real. This is a perfect example of that cycle in action. I mean, think back to the Great Recession around 2007 and 2008. That was a massive bear market. It was painful. But what happened right after? In 2009, a brand new bull run started, and it was one of the longest in history. Time and time again, history shows us that bear markets are always followed by bull markets. It's just the natural way of things. And get this, here's some really fantastic news if you're in it for the long haul. While those bear markets can feel pretty rough, the data is super clear. The periods of growth, the bull markets, they last way, way longer than the downturns.
That means that over time, the odds are really stacked in favor of growth. But, of course, there are times when the market doesn't just dip, it crashes. This is kind of the wild card in the whole deck. And yeah, the word crash sounds terrifying, but it's something we can actually understand and even prepare for. So what exactly is a crash? Well, it's just what it sounds like. A really sudden, really drastic drop in stock prices pretty much across the board. The best way to think of it is like a bear market, but on fast forward. It's a huge shock to the system for sure, but it's also what kicks off the market's whole recovery process. See, a crash isn't the end of the story. In fact, it often marks the beginning of a potential bear market. But after all that chaos, a process called a correction starts to happen. And this is basically the market's way of resetting itself and finding its balance again. And here's another really important piece of good news to hang on to. These super dramatic, sudden crashes, they're actually pretty rare. They make huge headlines because they're so unusual, not because they happen all the time. Okay, so now that we know all this, how do you actually build your own path to success? The secret isn't about trying to guess what the market will do next. It's about having a solid strategy in place, no matter if you're staring down a bull or a bear. So, let's talk about your toolkit. First and foremost, always do your research before you buy anything. Understand what you're putting your money into. And hey, if you're not sure about something, there is absolutely no shame in asking for help. A financial advisor or a broker can give you guidance. And yeah, it might cost a fee, but it's way safer to pay a little for good advice than to risk huge losses by going in blind. Honestly, if you only take one single thing away from all of this, let it be this right here: research. Doing your homework is the one thing that will draw that line in the sand between success and failure on your investment journey. It lets you make smart decisions based on facts, not fear. So there you have it, the optimistic bull and the pessimistic bear. They are the two faces of the market, and sooner or later, you're gonna meet them both. The real question isn't about trying to predict which one is around the corner. It's about this: are you prepared to meet whichever one shows up?
All right, let's dive right in. Today, we're talking about the one thing that really, truly separates the most successful traders from everybody else. And spoiler alert, it's not some secret algorithm or a magic stock pick. It's all about their mindset.
You know, it's the question every new trader asks themselves. And the answer, well, it's probably not what you're thinking. It has nothing to do with being unlucky or just picking the wrong company.
See, the real battlefield isn't the stock market at all. It's that little 6-inch space between your ears. If you can win the mental game, you're on your way to winning the trading game. It's as simple as that. Okay, so how do you actually win this mental game? Well, it all starts with laying a super strong foundation. Think of it like building your mental armor before you even think about placing a single trade.
This mental armor, it's really built on 3 core pillars. First, you've got to commit to always be learning, because hey, the market never stops changing. Then, all that knowledge gets forged into real strength through consistent practice. And finally, the whole thing is held together by you taking total ownership of every single outcome, whether you win or you lose.
Our source material just nails this point. Trading without the right knowledge means you're just making decisions based on fear or greed. Think about it. It's the difference between freaking out when your computer crashes versus being the IT expert who calmly diagnoses the problem. That's what knowledge does. It lets you replace panic with a clear, rational plan.
And you know, it's just like an athlete, right? They don't get stronger by just reading the playbook. And you're not going to build mental toughness by just watching the charts. You have to actually practice. Every tip, every strategy, every single day. That is how you build real strength.
And look, developing these habits, they're absolutely non-negotiable. It means you own your wins and your losses, so you can learn from both. It means you've got to push past what feels comfortable, because that's where the real growth happens. And this one is huge. You have to learn to tell the difference between a true gut feeling that comes from experience and a knee-jerk reaction that's just based on fear.
So, once you've got that foundation locked in, let's look at how this whole mindset actually translates into action. And believe it or not, it all starts the moment you wake up with your pre-market ritual.
Okay, first up, and the source material is super clear about this, a rushed morning leads to a flustered mind and, yeah, costly mistakes. If you're just rolling out of bed and jumping straight into your research, you are already behind the curve. The trick is to wake up earlier, give yourself that time to get centered, maybe meditate, so you can walk up to the market from a place of calm, not chaos. Next up,
the power of visualization. As the source material points out, Olympic athletes do this all the time to get ready for a win. And honestly, traders should too. By literally imagining yourself executing your plan perfectly, you're not just daydreaming. You're building real motivation and making the exact steps you need to take crystal clear in your mind. But here's the thing, it's not just about visualizing wins. The source material highlights the strategic value of preparing for the worst, too. Seriously, by taking just a moment to think about how you'll feel if you lose, you can stop yourself from making foolish, emotional decisions ahead of time. It's a mental exercise that helps you take practical steps like setting proper stop losses to manage your risk. All right, let's get to our final section. This is where the rubber meets the road, when you're in the heat of the moment, executing trades, and your discipline is really, truly put to the test. At any given moment, you can be one of two traders. There's the emotional trader, the one chasing highs and panic selling lows. And then there's the disciplined trader, who follows a plan, trusts their data, and acts with total objectivity. The thing is, you have to actively choose to be the disciplined one every single time. So, what does that discipline actually look like in practice? Well, for starters, it means being patient, understanding that this is a marathon, not a sprint. It means focusing on the hard numbers, the metrics, not the chaotic noise from financial news. And it means using proven tools like diversification to keep your cool when things inevitably get a little wild. And this right here, this is a huge reality check. No strategy works 100% of the time. The source material says that a plan that's right more than 60% of the time is considered effective, so let that sink in. Perfection isn't the goal, consistency and discipline are. You know, a huge part of being disciplined is leaning on objective data, not just your feelings. Take a metric like implied volatility, for instance. You don't have to be a math whiz, but understanding a gauge like this helps you figure out if a stock is priced fairly. It's the perfect example of a tool that lets you make decisions based on data, not market trauma. So when you boil it all down, it really comes back to this one crucial idea. Don't just go out and copy a successful trader's strategy. It won't work because you can't replicate their exact situation. Instead, like our source material advises, you have to cultivate the mindset of successful traders. How they think, how they prepare, how they execute. That is the real secret.
So there you have it. We've laid out the entire blueprint for a winning mindset, the foundation, the daily ritual, and the rules for execution. The only real question left is, where will you start? What is the very first habit you're going to commit to building starting tomorrow?
Okay, so we hear the words trading and investing thrown around all the time, right? A lot of people use them interchangeably as if they're the same thing. But what if I told you they're not just different strategies, but two completely different mindsets about money? Seriously. And getting a handle on this difference, it could honestly be the key to unlocking your entire financial future. So let's make this personal right from the get-go. As we dive into these two ways of thinking, I want you to ask yourself this one simple question. Are you wired for that quick cash rush, or are you playing the long game for real, lasting wealth? The answer, it might surprise you. It's pretty revealing. And look, the stakes here, they couldn't be higher. This isn't some boring lesson in financial jargon. We're talking about the actual path your life takes. It's that one little shift in your mindset that can literally be the difference between constantly struggling, living hand to mouth, and achieving real financial freedom. So how do you figure out which path you're on? Well, let's do a little self-diagnosis. We're going to go through a quick checklist of what makes up the trader's mindset. As we go, just see if any of this sounds a little familiar. Be honest with yourself. First thing on the list, how far ahead are you looking? I mean, is your main focus on what you can get, like, right now? A trader, their number one goal is almost always quick cash. A lot of times, it's just about making ends meet for the month, with not much thought at all about what happens down the road. Now, this quick cash mentality, it has some pretty predictable results, right? It means your default question is always, what's in it for me now, instead of thinking about the bigger picture. And that's exactly why you see people with this mindset getting suckered into those get-rich-quick schemes. You know the ones. They promise fast money, but have zero solid foundation. And what happens? They usually crash and burn just as fast as they popped up. All right, next question for you. Let's talk about patience. Are you all about grabbing the harvest the second it's ready, or do you actually value the process of growth? The stuff that makes the harvest possible in the first place. This is a really, really key difference. For a trader, patience just isn't in their vocabulary. Seriously, everything's got to be fast, quick cash, quick fixes, shortcuts, you name it. The idea of actually waiting for a business to grow and mature, to them, that just sounds foolish, like a total waste of time. They want the fruit like yesterday, without bothering to water the tree. Okay, last item on our trader checklist, and this one's all about knowledge. Do you ever find yourself jumping at an opportunity before you've really done the research, before you've even grasped the basics of how it works? You know, traders are often, well, let's just say they're not great learners. They don't really care about understanding a business. Nope, they only care about the profit they can squeeze out of it. And this makes them super vulnerable to hype and that classic FOMO, the fear of missing out. If something's trending, if everyone's talking about it, a trader is going to dive in head first. It's a total trial and error approach, and man, is it risky.
Okay, so that's the trader mindset in a nutshell. If some of that felt a little too familiar, hey, don't sweat it, because there's another way to play the game. Let's flip the coin and look at the investor's perspective, a completely different way of thinking about, well, everything.
And this right here just lays it all out crystal clear. I mean, look at the difference. The trader, all about the short term. The investor, they're in it for the long haul. A trader chases whatever's hot and trending, while the investor is busy studying the actual business. The trader wants that quick cash grab, but the investor, they're focused on sustainable growth, the kind of growth that builds on itself year after year. And maybe the most important thing, a trader sees customers as just a way to make a buck. An investor knows that those customers are the absolute key to making any of that long-term success even possible.
There's actually a really great metaphor that kind of sums this all up. Let's say an opportunity is like a single seed. A trader looks at that seed and all they see is one question. Can I eat this right now? If they can't get immediate value from it, they just toss it aside and move on. But the investor, oh, they see something totally different. They look at that exact same seed, and you know what they see? They see a whole forest. They're the visionaries. They get that with a little time, a little patience, and some care, that tiny little seed can grow into something huge, something that keeps on giving.
So, okay, we've seen all these different behaviors, right? Patience, knowledge, how they treat customers. But what's the real root cause here? Why are these two mindsets so fundamentally different? It actually boils down to one single, unifying thing.
Yep, you heard that right. Every single thing we've talked about, every habit, every decision, it all traces back to one core idea. This is the thing that separates the trader from the investor.
And here is the big reveal. It's long-term planning. That's it. That's the secret sauce. This is the absolute core principle that separates the two. And it's not just, having some vague goals for the future. No. It's a way of thinking that influences every single decision you make, from the assets you acquire to the people you invest your time in.
And here's why that's such a game changer. When you start thinking long-term, it changes everything. You're basically forced to think about sustainable growth because you're not just trying to survive the week. You have to actually learn stuff, gain real knowledge because you're planning to stick around. And it just naturally makes you want to invest in people, your customers, your team, because you realize they are your most valuable assets for that future you're building.
So let's bring it all back home, back to you. Now that you've got this framework, you can start applying it to your own life, your career, your money, everything. So ask yourself, are you just eating the seeds as you find them? Or are you starting to think about planting a forest?
Because in the end, it all comes down to this one powerful idea. Think about it. Your future, your time, your money, your energy, all of it, it's a seed. A trader sees that seed and eats it for lunch today. An investor plants that seed to grow a forest for tomorrow. The choice, well, it's all yours. So what are you going to do with it?
Today, we're diving into one of the absolute cornerstones of smart investing, diversification. Seriously, if you think of investing as heading into battle, then diversification is your shield. It's what protects you when the market gets, well, stormy.
But let's be real for a second. Why is investing so incredibly nerve-wracking? You know that feeling, right? That knot in your stomach, even when you feel like you've done all your homework. What is that all about? Well, the answer lies in a risk that's often hiding in plain sight. It's because of the domino effect. All it takes is one single piece of news, a sudden economic shift, a surprise interest rate hike, and suddenly it feels like your entire portfolio could come tumbling down. When everything you own moves in lockstep, your risk isn't just big, it's supercharged.
And that brings us to the core problem that every single investor has to grapple with. It's this danger of uniform reactions. It's not just about what you own, it's about how all those things you own behave together. So here's where that hidden risk really lives.
You might look at your portfolio and see stocks, some ETFs, maybe a few bonds, and think, hey, I'm spread out, I'm safe. But if they all tank the minute the economy sneezes, you're not actually diversified. You've accidentally built your entire financial house on a single shaky pillar. So the big question is, how do we fix this? How do we build a portfolio that can actually weather a storm? Well, that brings us to the solution. Let's call it the cogwheel approach, which is really just a powerful way to visualize diversification. Okay, let's get a really clear definition down. Diversification is not just about randomly spreading your money around. No, it's a deliberate strategy. It's about carefully picking assets that you expect will react in different ways to the exact same economic event. That's the secret sauce right there. Different ways. Or to put it in a much simpler way, you don't want to bet on the same horse for too long. And that horse isn't just one company stock. It could be an entire industry, a whole country's economy, or a certain type of asset. The goal is to have a whole stable of different runners in the race. And that brings us back to the cogwheel. The goal is to build a portfolio that works like a set of interlocking gears. So when one part of your portfolio, one gear, turns down because of some market news, it's actually designed to make another gear turn up. It creates this beautiful internal balance, even when the outside world is chaotic. Okay, that all sounds great in theory, but what does it actually look like in the real world? Let's take a look at how these opposite reactions really create the balance we're after. Here is a classic textbook example: oil versus airlines. Think about it. When the price of crude oil skyrockets, who's happy? Well, oil companies are, and their stocks might go right up. But for an airline, oil is one of their biggest costs. Higher fuel prices can crush their profits, and their stocks will often take a nosedive. So if you own both, the hit you take on the airline side is cushioned by the gains on the oil side. See? The cogwheel is turning. And this balancing act happens all over the place. Take airlines versus railroads. If some event makes people nervous about flying, where do they go? Often they turn to trains, so railroads might see a nice little bump. Or look at the big one, stocks versus bonds. When interest rates start climbing, stocks can get hammered, but certain types of bonds actually become more valuable. It's all about that yin and yang. Okay, I know what you might be thinking. Diversification sounds amazing, like some kind of magic bullet for investing. But let's get real. It's not perfect. Like any strategy, it has trade-offs. And to be a smart investor, you've got to understand the good and the bad. So the pros are pretty clear. It's your shield against that wild market volatility, and it gives you the peace of mind to stay in the game for the long haul. But, and this is a big but, there are real downsides. By spreading your bets, you're pretty much guaranteed to miss out on that one stock that goes completely to the moon. You're trading those spectacular lottery ticket wins for steadier, more average returns. And managing a ton of different things can get complicated, leading to analysis paralysis, or it can just rack up transaction fees. So, let's just boil it down to one crucial point. Safety has a cost. The price you pay to protect yourself from a huge loss is that you will almost certainly miss out on the biggest, most explosive gains. You're basically trading the chance to hit a grand slam for the certainty of never striking out. So if this isn't about becoming a millionaire overnight, and it's not about trying to eliminate every last drop of risk, then what's the point? The point is finding your sweet spot. It's all about finding a balance that lets you sleep at night. So how do you find that balance? Well, it really comes down to three things. First, you've got to monitor your investments. This is not a set it and forget it kind of deal. Second, find that happy medium. Don't be the person checking your stocks every 5 minutes, but don't ignore your portfolio for 5 years either. A quick check-in every quarter is usually a pretty good rhythm. And third, and this might be the most important one, you have to adopt the right mindset. Because at the end of the day, so much of successful investing is psychological. It's about having the self-discipline to tune out the roar of fear and greed. It means you can't fall in love with a stock. Your decisions have to be driven by logic and your strategy, not by a gut feeling you had on a random Tuesday. So after all that, after weighing the pros and the cons, what's the final verdict? It's pretty clear. Despite the trade-offs, diversification is absolutely 100% worthwhile. It's what gives you the confidence and stability to stay invested for the long run. And that's where real wealth is built. So I'll leave you with this final thought to chew on. Take an honest look at your own investments.
Is your portfolio actually built to survive a storm? Is it ready for things to get rough? Or is it really just built to sail on calm seas in sunny weather, leaving you totally exposed the moment the wind changes? All right, let's talk about something that could be quietly eating away at your profits, something a lot of traders just don't think about. We're talking about your trading tools. This is a huge piece of the puzzle, and it's so often overlooked. So let me ask you a question. Do you kind of figure that all online brokers are more or less the same deal? I mean, they let you buy, they let you sell. What else is there, really? Well, you know that little assumption? It can be an incredibly expensive one. It's one of those small details that can end up having a huge impact on your final numbers. And that brings us right to what we can call the broker blind spot. It's this habit of focusing 100% on what to trade, but totally forgetting to think about how you're trading it. And believe me, the how is way more important than you think. This quote from our source material just nails it. A lot of newbie investors think that one online brokerage is essentially the same as all others. It's that exact thought process where potential profits just disappear into thin air. Okay, so how exactly is this costing you money? Well, it really boils down to two main things. Two hidden costs that we need to drag out into the light. These are the two big ways your platform could be silently killing your returns. And here they are, side by side, the two big profit killers. On one hand, you've got high fees. That's the obvious one, right? The one everyone looks for. But on the other hand, you have something way sneakier and honestly, often a lot more damaging, slow execution. So let's talk fees for a sec. They are not all the same. Some platforms have a flat fee, but that fee can be wildly different from one place to another. Others might charge you based on how many shares you buy or even the total dollar amount of the trade. The bottom line here is you have to really look at the fine print and compare apples to know what you're actually paying. But here's the thing. As bad as fees can be, slow execution can be even more of a silent killer for your portfolio. It's not as obvious, but wow, the impact can be massive. Let me just walk you through a quick scenario so you can see what I mean. Okay, picture this. You've been watching a stock, you've done your homework, and bam, it drops down to what you think is the perfect entry point, 25 bucks a share. This is it. This is your chance. So what do? You grab your phone, you pull up the app, and you slam that buy button. But crickets. The platform is lagging. And in just those few seconds of delay, the market doesn't wait for you. The price starts bouncing back up. By the time your order finally gets processed, that $25 price is long gone. The price you actually pay? $27. And just like that, you've lost $2 a share before your trade has even had a chance to breathe. It wasn't a bad decision on your part. It was your tool that failed you at the most important moment. Now, multiply that $2 by 100 shares or 1,000, you get the idea. It's devastating. So how do you stop this from happening to you? How do you avoid getting burned by these hidden costs? Let's get to the good stuff. We've got a super simple 4-point checklist that'll help you pick the right tools to actually make money. First up, number 1. This is the foundation of everything. You need a low-cost trading platform. This is your first and best defense against having your profits chipped away. But listen, low cost doesn't just mean a $0 commission. You got to dig deeper. You have to look at the entire fee schedule, check out the whole service package, and be really careful of tricky pricing that seems designed to confuse you. Things like inactivity fees or crazy high withdrawal costs. All right, number 2 on our list, and this goes right back to that story we just told. You absolutely need a fast trading platform. Seriously, speed is not a nice to have. It is essential. It's a non-negotiable. You have to demand fast trade execution. It's so important, especially if you're trading anything that moves quickly, volatile stocks, momentum stocks, you name it. Speed is what lets you lock in the price you see on the screen, not some other price you get stuck with seconds later. Okay, number 3. This one's about the data you're looking at. Fast updating charts. I mean, think about it. Your decisions are only as good as the information you're working with, and delayed data? That's just bad information. So what are we talking about here? We're talking about real-time data, period. No excuses. If you're an active trader of any kind, whether you're in and out in a day or over a few weeks, delayed charts are basically useless. Real-time charts let you see things as they happen and jump on opportunities right away, not minutes after they're gone.
And that brings us to our last point, number 4. Now, this one isn't as sexy as fast charts, but trust me, it is so important. Solid accounting. And I don't mean you need to hire a guy. I mean the accounting features that are built right into your platform.
And why is this such a big deal? Well, taxes. Simple as that. In most places, your short-term trading income is taxed just like regular income, so your platform absolutely has to track every single gain and loss accurately. This isn't just for your own records, it's what you need to report correctly to the tax man. It's a legal must-have. All right, so let's tie all of this together. The whole point is to trade smarter, not just harder. And honestly, the very first smart, profitable move you can make is just choosing the right partner, the right platform to begin with. So remember that checklist. It's simple. Low cost, a fast platform, fast real-time charts, and solid built-in accounting. Get those 4 things right, and you are starting off on a much, much better foot than most people.
So I'll leave you with this one last question to think about. Go look at your own platform right now and be honest with yourself. Is it a real partner that's helping you win, or is it just another hidden cost that's holding you back? Hey there. So you want to get into investing, but maybe you're feeling a little lost. Like, where do you even begin? Well, you are in exactly the right place. Today, we are going to pull back the curtain on mutual funds. And trust me, by the time we're done, you'll know exactly what's up. Let's dive in. I mean, does the thought of trying to pick the next big stock or stressing about the market's every little move, does that just feel overwhelming? Yeah, you are not alone. That feeling is a huge reason why so many people just end up doing nothing at all. All right, so let's get real about why trying to be a lone wolf investor is just so tough, especially when you're starting out. It's not as simple as it looks on TV, that's for sure. Just think about it for a second. Trying to pick winning stocks? Man, that is hard. Even the professionals get it wrong all the time. And the stress, constantly worrying about losing your hard-earned money, ugh. Plus, building a properly diverse portfolio, not putting all your eggs in one basket, that takes serious time and, frankly, a lot of cash. It really is a full-time job. But what if you could skip all that headache? What if you could basically hire a pro to handle the tough stuff and get instant diversification right from the get-go? Well, that, my friends, is exactly where mutual funds come into the picture. They're kind of like an all-in-one investment kit. So let's break down what these things are and how they actually work. Okay, so here's the simplest way to think about it. A mutual fund is basically a big pot of money. Lots of investors, people just like you and me, all chip in. Then a professional fund manager takes that giant pool of cash and invests it in a whole bunch of different things. Stocks, bonds, you name it. Their entire job is to manage that money for everyone. So how does it all shake out? It's really just 3 simple steps. 1, you and a bunch of other people pull your money together. 2, the professional manager takes all that money and invests it according to a specific game plan. And 3, you don't own the individual stocks. Instead, you own units of the whole fund. Think of it like owning a slice of a giant diversified pizza. Okay, so how much is your slice worth? That's where something called the net asset value, or NAV, comes in. You can just think of it as the price for one unit of the fund. And here's a key thing to remember. Unlike a stock price that's jumping around all day, the NAV is only calculated once a day, after all the trading is done. It's a much calmer way to track your investment's value. All right, so it's super important to know that not all mutual funds are the same, not even close. They're kind of like tools in a toolbox, each designed for a different job. This means you get to pick one that actually fits your goals and, how much risk you're willing to take. So let's look at some of the most common flavors. You've got aggressive growth funds. These are high risk, high reward. Think startups and new tech. Then there are growth funds, a little less wild, focusing on solid U.S. companies. Growth and income is even more conservative. We're talking big, stable, blue-chip companies here. And of course, international funds do exactly what they sound like. They invest in companies all over the world. Okay, having a pro manage your money and getting instant diversification, that sounds pretty amazing, right? But, and this is a huge but, there's a catch. That expertise isn't free. And this, right here, is where you need to lean in and listen really, really closely. Because, as our source material warns, those expenses will eat into your earnings. And it's not a maybe, it's a will. This is honestly the single most important thing you need to get about mutual funds. It can make or break your entire investment. The biggest fee you'll see is called the expense ratio.
It's a yearly fee, a small percentage of your investment that goes to paying for everything, the manager's salary, research, all that stuff. Now, this fee is the reason people talk about actively managed versus passively managed funds. Active funds have a manager trying to beat the market, so they charge more. Passive funds just track an index, like the S&P 500, so their fees are way, way lower. Now, these percentages might look tiny, but trust me, their impact is anything but.
So let's play a little game. Which fund would you pick? Fund A has an expense ratio of 0.64%. Pretty average. Fund B is at 2.5%. Definitely on the high side. Now, on paper, that difference is less than 2 percentage points. I mean, how much damage could that really do over time? How about $115,514? No, I'm not kidding. That's how much extra the higher fee fund would cost you over 20 years on a $100,000 investment. That's a car, that's a down payment on a house. That is money that should be in your pocket, but instead, it just vanishes into fees. And get this, the expense ratio isn't even the whole story. You got to watch out for other sneaky fees, like commissions when you buy, redemption fees when you sell, exchange fees, account fees, the list goes on. The moral of the story? You have to read the fine print.
So, how do you sidestep these traps and invest like a smart, savvy pro? It's actually not that complicated. You don't need a finance degree. You just need a simple checklist.
Here it is, your smart investor's playbook. Number 1, hunt for low expense ratios. The lower, the better. We're talking about those passively managed funds that can be around 0.2%. Number 2, always check the 10-year performance. Don't get suckered in by one lucky year. And number 3, compare it to a benchmark. How does it do against the S&P 500? Because if your fancy, high-fee fund can't even beat the average, then what are you paying for?
So at the end of the day, what's the right choice? Well, that really comes down to you. It's about your goals, how much risk you're cool with, and really, how much you want to be involved in the day-to-day. Here's a quick cheat sheet for your investing style. If you want to be in the driver's seat, picking and choosing every little thing, then individual stocks are your game. If you want that diversification, but with a little more control, you should look into ETFs. But if what you really want is to set it, forget it, and let a professional handle things, a low-cost mutual fund could be your absolute best friend.
So we've come full circle. You know what mutual funds are, you know how they work, but you also know about their biggest, most expensive secret, those hidden fees. So now that you know, the real question is, what are you going to do with your money?
Hey, welcome. Today, we're going to dive into what might just be my favorite kind of investment, the exchange-traded fund, or ETF for short. It's one of the most powerful tools out there for an investor, and it was created to solve a problem that pretty much everyone faces when they first start out.
So what is this big dilemma? Well, every new investor is staring down a fundamental choice that can feel, honestly, pretty overwhelming when you're just trying to get your feet wet.
And that choice boils down to this. Do I buy individual stocks, or should I go with mutual funds? This one question has tripped up millions of people. Both of them have their good points for sure, but they also come with some pretty big drawbacks.
So let's just break down the trade-offs, right? With individual stocks, you get total control. You can trade whenever the market's open, you call the shots. The big downside? It is incredibly hard to get properly diversified, and let's be honest, picking individual winning stocks is really, really risky. Then you've got mutual funds, which give you that instant diversification. But they often come with high fees, you're handing control over to a fund manager, and you can only trade them once a day after the market closes. Kind of frustrating.
So you're kind of stuck. You want the control of stocks, but the safety of a mutual fund. So what if you could just wave a magic wand and create a new type of investment that took all the best parts of both?
Well, it turns out you can. That magic wand actually exists, and it created what we now know as the ETF. It's truly a smarter way to invest that solves that exact dilemma we were just talking about.
So, what exactly is an ETF? Think of it like this. It's a fund that holds a whole bunch of assets, like stocks or bonds, but the fund itself trades on a stock exchange, just like a single share of a company. So you get the awesome diversification of a mutual fund, but you get the trading flexibility and control of a stock. It really, truly is the best of both worlds.
And this combination gives ETFs some incredible advantages. I like to think of them as their superpowers, especially for anyone who's looking to build a solid long-term portfolio without all the usual headaches.
We're going to break down 3 main superpowers here. You've got automatic diversification, you've got ultra-low costs, and you have all-day flexibility. Let's get into it.
Okay, the first one, and you could argue it's the biggest, is automatic diversification. When you buy just one share of an ETF that tracks, let's say, the S&P 500, you are instantly buying a tiny little piece of all 500 of America's largest companies. Trying to build that on your own would be, well, pretty much impossible. With an ETF, it's done in a single click.
Next up, costs. Every fund has something called an expense ratio. That's just the annual fee you pay to own it. And this is where ETFs really shine. Because most of them are passively managed, meaning they just follow an index automatically, their fees are often way lower than traditional mutual funds. And I mean, the costs can be almost unbelievably low. It's not crazy to find an ETF with an expense ratio like this one, 0.05%. Think about what that actually means. For every $1,000 you put in, you're only paying 50 cents. A year. That's it. Over time, that tiny difference adds up to a massive amount of money staying in your pocket. And finally, we've got flexibility. Remember how mutual funds only let you trade once a day? Well, ETFs trade all day long, just like a share of Apple or General Motors. This means you can react to what the market is doing in real time and have way more control over the price you actually buy or sell at.
So we know ETFs are powerful, but just how big is their universe? The amazing thing is, you can use ETFs to invest in pretty much anything you can think of, anywhere in the world.
You can buy ETFs that track the big stock indexes, like the S&P 500 or the tech-heavy NASDAQ 100 with a fund like QQQ. But you can also invest in bonds, real estate, entire countries, or even commodities. You want to own gold, but, not have a giant gold bar in your house? There's an ETF for that, like GLD. The options are just about endless.
And investors have embraced this idea in a huge way. The first modern ETF was born up in Canada back in 1990. The first US version, SPY, which is still around, launched in '93. By 2010, the total amount of money in ETFs hit $8 trillion. And then, just 7 years later, that number more than tripled to $3.4 trillion. That's just explosive growth.
Okay, so that all sounds great in theory, but how do you actually go about choosing the right ETF for you? Well, it all comes down to doing a little bit of homework and comparing your options side by side.
So let's walk through a real-world example. Let's say you want to invest in smaller US companies. You go looking and you find two different ETFs that both do that. One's from iShares, the other is from SPDR. How in the world do you decide between them?
Here's how you do it. You put them in a face-off. First thing you look at is the expense ratio. Right away, you can see the SPDR fund is way cheaper. Next, look at the share price. It's much lower, which might make it easier to buy full shares, depending on your budget. And finally, you look at performance both this year and over the last 5 years, and you see the SPDR fund has come out ahead in both cases.
So you might be asking, wait, if they're both tracking the same market, why are the results different? That is a great question. It's because even with the same goal, they might be tracking slightly different indexes, kind of like following two slightly different recipes. They might hold different companies or different amounts of the same companies, and over time, that leads to different results.
So, now, looking at this data, which one seems like the better deal? You've got the SPDR fund with a lower cost, a more accessible price, and it's shown stronger performance. Thinking through these kinds of factors is exactly how you start to analyze an investment for yourself.
And look, that's the whole goal here. This isn't about us giving you financial advice or picking a winner. The whole point is to show you the framework, to give you the tools and the confidence to look at the data and make your own smart decisions based on your goals.
So what's your path forward from here? It's actually super straightforward. First, you use the amazing free tools on fund websites like iShares, SPDR, Vanguard to research your options. Second, you compare the key stats for the funds that match what you're trying to do. And third, you just buy your chosen ETFs through any normal online brokerage account. It's that simple.
At the end of the day, ETFs are just a set of incredibly powerful and flexible tools. They give you low-cost, diversified access to the entire global market right at your fingertips. The only question left is, what are you going to build with them?
All right, let's talk about trading stocks. If you're looking to get into the market, you've probably figured out that just hoping for the best isn't really a plan. You need a set of proven strategies. So today, that's what we're going to do. We're going to build that toolkit together.
Here's how we'll break it down. First, we'll cover why you can't just rely on luck. Then, we'll dive into the two main ways of thinking:
fundamental versus technical analysis. From there, we'll get into specific game plans, like value and growth investing, add a few more specialized tools to your kit, and then finish up by talking about what it really takes to get good at this.
So, first things first, why isn't this all just about getting lucky?
I mean, it's a real question, isn't it? Can you just pick a hot stock, cross your fingers, and wait for the money to roll in? Is it basically just one big casino? Well, the source material we're looking at today has a very, very clear answer to that.
And there you have it. You might get lucky once or twice, but for consistent profits, you need a plan. See, luck runs out, but a solid strategy is something you can use over and over again. Investing is a skill, and like any skill, it takes practice, which starts by building this toolkit of core approaches. Okay, so this brings us to the two big philosophies in stock analysis. You can think of them as two completely different roads you can take on your investing journey, and each one gives you a totally different view of the market.
First up, we've got fundamental analysis. This is where you basically become a financial detective. You're digging deep into a company's health. We're talking earnings, profits, debt, the whole 9 yards. All to answer one simple but crucial question. What is this company really worth?
This slide just nails the difference. On one side, you have the fundamental analyst, our financial detective, asking, what's this company's true worth? They're using financial statements as their clues. Then you have the technical analyst, the chart reader, asking a totally different question. Where is the stock price going next? And their answers are found in price charts and trading volume.
And that really is the heart of technical analysis. The idea here is that everything you could possibly want to know, all the news, the earnings, the investor feelings, it's all already reflected in the stock's price. So if you can read the chart, you're pretty much reading the market's mind, or at least its body language.
Now, this is always the big question, right? Especially for the skeptics. Is looking at charts just like seeing shapes in the clouds? Or are there actual identifiable patterns that can give you an edge?
And this is a fantastic illustration that, yeah, these patterns are real. What you're looking at is a daily chart for Apple. A technical analyst would see this rising, sloping channel immediately. See how the price bounces between those two parallel lines? They'd use that exact pattern to predict where the stock might be headed. So it's not random. It's about recognizing how the market behaves time and time again.
Okay, so we've got our two main philosophies. Now let's build on that and look at two of the biggest playbooks that investors use every single day: value and growth investing.
You gotta love the analogies here. Value investing is like bargain hunting. You're out there searching for a really solid company that, for whatever reason, the market is overlooking. You're trying to buy it on sale. Growth investing, though, that's more like talent scouting. You're looking for the next big thing, a small new company that has the potential to absolutely explode and dominate its field. For a value investor, the process is pretty straightforward. First, you do that deep dive fundamental analysis to figure out what a company is truly worth. Then, you hunt for stocks that are selling for less than that value. The whole bet is that eventually the market will wise up and the price will correct itself. A growth investor's checklist looks a little different. They're trying to spot brand new businesses with a ton of room to expand. They're analyzing how these companies stack up against their rivals and trying to figure out if people are actually going to buy what they're selling. It's way less about what the company is worth today and all about what it could be worth down the road.
All right, so beyond those big picture playbooks, there are some more specific tactics you can add to your kit. Let's look at a couple of these specialized tools.
So, first, there's a technique called averaging down. The idea here is pretty simple. If you really believe in a stock for the long haul, then a price drop isn't a disaster, it's a buying opportunity. You buy more shares as the price falls, which brings down your average cost for each share.
Let's just walk through the math real quick. Say you buy 10 shares for $10 each. Then the price drops to $9. Instead of freaking out, you buy 10 more. Now you own 20 shares, but your average cost per share isn't $10 anymore, it's $9.50. That means the stock doesn't have to climb all the way back to $10 for you to break even, it only needs to get back to $9.50.
But, and this is a huge but, it's super important, this is a very aggressive strategy. It only works if you're right and the stock actually recovers. If you're wrong, you're just throwing good money after bad. Your success here is completely tied to the quality of your research.
Another thing to understand is a stock split. This is when a company's share price gets really high, so they decide to split each share into multiple new ones to make the price lower and more accessible. A $40 stock might become two $20 stocks. The key thing to remember is that this is usually a good sign. It often means the company is healthy and growing.
Now, this is where you have to pay attention.
Because there's an opposite to a stock split, and it's almost never a good thing.
It's called a reverse split. And here, a company combines its shares to make the stock price look higher. So 10 shares at $10 might become 5 shares at $20. The source we're looking at calls this a manipulative action because the price is going up for a technical reason, not because the business is doing well. It's often a huge red flag that a company is in trouble. A split can be good, a reverse split is almost always bad news.
So we've covered philosophies, playbooks, and specific tactics. But the source material makes one thing crystal clear. The most important, the ultimate tool in your entire kit is you.
And I think this quote just says it all. It's not enough to just know about a strategy. The real goal is mastery. To understand a company and its stocks so deeply that you almost have a sixth sense for it. It's all about constantly learning and going way beyond just surface-level knowledge.
So we've laid out all the tools. We've seen the financial detective, the chart reader, the bargain hunter, and the talent scout. Now the final question is really for you. Which of these tools are you going to put in your kit, and what kind of investor are you going to become?
All right, let's be real. Every single one of us has stared at a stock chart, hand hovering over the mouse, wondering, is now the time? Is this the moment I buy, or should I sell? It really is the million-dollar question, isn't it? Well, today we're going to try and build a game plan to help you answer that with a whole lot more confidence. You know, at the end of the day, investing is all about timing. We all know that old saying, buy low, sell high. Easy to say, right? But how do you actually pull that off? How can you tell when you're at the bottom, and how do you know when you've hit the top? That's the big puzzle we're here to piece together today. So think about this for a second. It's kind of funny how our brains work. When you see a TV you've been wanting is suddenly 50% off, you get excited, right? It's a bargain. You want to rush out and buy it. But when the stock market has a 50% off sale, what do most people feel? Pure fear. It's this weird paradox that makes totally smart shoppers panic when it comes to investing. Okay, so to break out of that cycle of fear, we have to stop just reacting to the market and start thinking like a strategist. This first part is all about building that foundation. How to figure out what a stock is really worth way before you even think about clicking that buy or sell button. And this is exactly why that strategist mindset is your secret weapon. The market can be like a stampede of emotion, and when fear kicks in, that herd just thunders toward the exit. The investor who actually succeeds is the one who can stand back from all that chaos, take a breath, and think for themselves. So how do you do that? How do you become that independent thinker? Well, it pretty much boils down to these 3 steps. First, you set a target, but forget about chasing one single perfect price. You want to define a range where you feel good about buying. Second, you gotta play detective. Is this stock cheap for a good reason, or is the market just missing something? And third, and this one is absolutely non-negotiable, you have to do your own homework. Don't just rely on a catchy headline or that tip you got from a friend. One of the best tools for your detective work is something called a discounted cash flow analysis, or DCF. I know, it sounds super complicated, like something from a grad school textbook. But the idea is actually pretty simple. Imagine you're buying an apple tree. A DCF basically helps you guess how many apples that tree will produce over its lifetime, and then it calculates what all those future apples are worth in today's dollars. If the price of the tree is less than the value of all its future apples, hey, you might have found a great deal. Another fantastic tool is the price-to-earnings ratio, or PE. Think of this one like a price tag that lets you compare different items in the same aisle. By looking at a company's PE ratio and then checking out its competitors, you can get a quick sense of whether you're looking at a luxury brand or something from the discount rack. It's a really handy shortcut to see how a stock is valued inside its own industry. And that brings us right back to that critical third step, the homework. So where do you actually find all this info? It's probably easier than you think. You go straight to the horse's mouth. Dive into the company's annual reports, read their press releases, watch their investor presentations. Seriously, every public company has an investor relations page on their website. Just think of it as your own personal treasure map to find the real story. All right, so you've done the homework, you found what you think is a hidden gem, and you've put your money in. Now you just lean back and watch it grow, right? Well, not so fast. The next part of this puzzle, and maybe the hardest part, is patience. Here's the thing about the market. It works on its own schedule, not yours. You might have found the most amazing, undervalued company in the world, but it can take a long, long time for everybody else to notice. Anyone who tells you they can guarantee you a quick profit in a few months is probably just selling you a fantasy. Real value takes time to unfold. So just how long are we talking? Well, if you've done your research and you truly believe in the company, you should be prepared to hold on for about 3 to 5 years. Yeah, years. That's often the kind of timeline it takes for the market to finally recognize a company's true worth. Now, while patience is the key to your long-term strategy, there are some really interesting short-term patterns that can help you with the timing of your trades. You can think of it like a trader's calendar. Now, these aren't ironclad laws or anything, but they are fascinating trends that people have noticed over the years. Ever get a case of the Mondays? Well, it turns out the stock market might too. It's a thing called the Monday effect, and for decades, there's been this tendency for stock prices to dip a little at the start of the week. Who knows why? Maybe companies release bad news over the weekend. Maybe everyone's just in a bad mood. Whatever it is, Monday is often a pretty good day to buy. And on the flip side, people tend to get more optimistic as the weekend approaches, so Friday often ends up being a better day to sell. And these calendar quirks don't just stop with the days of the week. We see them on a monthly basis too. Stocks often get a little boost at the beginning of the month when new paychecks and investment funds flow into the market. Then things tend to quiet down around the middle of the month, say between the 10th and the 15th. So again, if you're looking for a slight edge, these little trends can be a helpful guide. So, what's the big takeaway from all this? It's actually pretty simple. You have to know the difference between your core strategy and your short-term tactics. That deep dive analysis into a company's real value, that's your foundation. These calendar trends we just talked about, they're just tools you can use. They're absolutely no substitute for doing solid research. So there you have it. You're now armed with the strategist's mindset, the trader's calendar, and hopefully a new appreciation for patience. You know the difference between a stock's price and its actual value. So the next time the market takes a nosedive and everyone is panicking, what are you going to do? Will you get swept away with the herd? Or will you be the calm one in the storm, ready to spot an opportunity? The choice is all yours. Welcome to The Explainer. You know, when you're just starting out in trading, money management can feel, well, pretty overwhelming. So today, we're going to break it all down. We're looking at a guide that really lays out a clear path from being a total rookie to becoming a potential pro. All right, let's just jump right in with this quote, because it's a huge promise. We're not just talking about winning a trade here and there. No, this is about something much bigger. The incredible potential that gets unlocked when you actually manage your profits the right way. Okay, so here's what we're covering. We'll talk about that millionaire potential. Then, the big one, the leverage trap. After that, we'll get into your defensive playbook, how to trade with a real strategy. And finally, nail down that winner's mindset. First up, let's talk about the big goal. I mean, turning those trading profits into actual long-term wealth, it's not about what you go out and buy. It's all about how you manage what you've earned. And here's the thing. This is so crucial. Before you even think about getting rich, you just have to survive. That's it. Think of good money management as your life raft, right? In these crazy, volatile markets, it's the one thing that keeps you afloat long enough to actually have a shot at success. Okay, let's shift gears. We need to talk about the number one threat, the thing that can absolutely wreck a new trader's account, sometimes so fast they don't even see it coming. And our source material is super clear on this. Look, there are a ton of risks in trading, for sure. But for a beginner, there's one that's just in a league of its own, and that is let's call it the siren song of leverage. So what even is this thing? Well, think of leverage like a giant amplifier for your money. It lets you use a little bit of your own cash to control a huge position. And yeah, that sounds awesome when you're winning, but here's the catch. It's an absolute disaster when you're losing, because it magnifies your losses just as much. So, how do you survive that trap? Well, you can't just cross your fingers and hope. You need a real defensive game plan. And lucky for us, our source gives us 2 tools that are absolutely essential for that playbook. In this first one, it is so powerful because it's so simple. This isn't some vague idea either. This is a hard and fast rule, something you need to calculate before you even think about getting into any trade. So how does it work? It's simple, really. For every $1 you're willing to risk losing, you need to have a realistic shot at making $3 in profit. So if you're looking at a trade and you could lose, say, $100, your potential gain has got to be at least $300. If it's not, you just don't take the trade, period. It's a simple piece of math that stops you from making emotional decisions and taking bad bets. Okay, tool number 2. This is your safety net. and it has to be non-negotiable. It's called a max dollar stop loss. You basically set a limit on your trading platform that says, hey, if I lose this much money today, I'm out. The computer kicks me out. It's an automatic shut-off switch that saves you from yourself, from your own greed, your desperation, all those things that make you want to overtrade.
And this right here, this is the core difference, isn't it? A gambler just keeps betting, chasing their losses, hoping the next one's a winner. But a disciplined trader, they use a stop loss. They decide their maximum pain point before they start. And when they hit it, they're done for the day. It's what turns trading from a spin of the roulette wheel into an actual calculated business decision.
Okay, so we've got our defenses set up. Now let's get on the offense. Let's talk about strategy. Because honestly, having a real strategy is what separates the folks just messing around from the actual pros. You know, our source uses a great analogy here. It compares trading to football. Think about it. You don't just show up on game day and wing it, right? No, you have a playbook. And the team that has the better strategy and actually follows it is the one that's going to win. So what is a strategy, really? It's just a set of rules you create for yourself. It tells you exactly when to get into a trade and, just as important, when to stay on the sidelines. It means you've done your homework, you've looked at the patterns, and you are never, ever going to make a crazy, high-risk trade just because you're trying to win back money you just lost. All right, and that brings us to the final piece of the puzzle. And honestly, this might be the hardest part of all. It's not about being a genius at reading charts. It's about mastering your own mind. Our source is pretty blunt about this. Your emotions are the biggest enemy to your strategy. Greed will tell you to hold on to a winner for way too long. Desperation will scream at you to jump into a bad trade after you lose. And both of those voices, they lead you to the exact same place. Huge losses you probably can't come back from. And this is such a critical warning. The #1 psychological trap for a new trader is trying to fix a bad trade with an even worse one. The source calls this a tricky move. And you know what? It almost always blows up in your face. A loss is a loss. It's a lesson. It's not a problem you solve by doubling down on risk. Because in the end, it really all boils down to this, doesn't it? Every single decision you make, the choice to stick to your stop loss, to only take 3-to-1 trades, to just shut it down for the day when you're supposed to. All those little things, they build the habits, they build the discipline. And that's what separates the winners from everyone else. Your success tomorrow is built on the decisions you make today. So let's wrap this up. Here's the big takeaway from all this. The market, it really doesn't care about what you hope for. It doesn't care about luck. It only rewards one thing, your discipline. So you have to ask yourself, are you going to be a gambler or are you going to be a strategist? The choice is totally up to you.
You know, when we think about successful investors, we usually picture someone with a ton of cash, right? But what if I told you the real game, the one that truly matters, is played right up here, in your head? Today, we're going to dive into why your psychology can be your single greatest asset or, yeah, your biggest enemy.
So let's just get right to it. What is the actual secret to winning at investing? Is there some hidden formula, some magic trick? Or is it something much, much closer to home?
Well, I can tell you this. The answer isn't buried in a secret stock tip or some kind of super complex algorithm. Nope. The real key to unlocking your potential as an investor, it's already inside you.
The secret is learning to master the game inside your own mind. It's all about what the pros call investor psychology.
So what in the world is investor psychology? Honestly, think of it like a user manual for your own brain when you're dealing with money. It's the study of how we act, how we think, and how we react with our investments. And understanding that gives us this incredible roadmap of what actually works, and maybe more importantly, what really, really doesn't.
And you really need to get this, because most of us, and I mean most of us, fall into these totally predictable mental traps without even knowing it. So let's break down 4 of the most common ones that can just completely sabotage your success.
First up, we've got something called the anchoring trap.
This one is, well, it's pretty straightforward, but man, is it dangerous. Anchoring is when you get stuck on old information. You just cling to it. Remember that hot stock tip from like 5 years ago? If you're still making decisions based on that, you're anchored to the past. The market is always changing. The big takeaway here, you've got to stay informed and keep an open mind. Okay,
Next up is a mental hurdle that's all about hearing exactly what you want to hear. This is the confirmation trap. This one is so subtle, it's sneaky. It's our brain's natural desire to find advice that confirms what we already think. Or, even worse, maybe you keep listening to that one friend who's, let's be honest, always wrong about the market. It takes real discipline to break that cycle, but the fix is simple. If the advice isn't working, it's time to find a new source, period. And that brings us to a mistake that is just so incredibly common. It's called the relativity trap.
This is the classic keeping up with the Joneses, but for investing. You see your buddy making a killing on some new crypto coin, and you feel that pressure, that FOMO, to jump right in. But here's the thing. Their money situation, their goals, their comfort with risk, it's totally different from yours. Your investment journey is yours alone, so your choices have to be based on your goals and your resources.
And finally, we have the one that can trip up even the smartest, most well-read investors out there, the superiority trap. So you've read a few books, you've watched a bunch of videos, and all of a sudden you feel like you know more than the pros who've been doing this for decades. That, my friend, is the superiority trap. The truth is, reading about swimming isn't the same as actually jumping in the pool. The market is a complex beast. The solution? Humility. You gotta seek out guidance from people with real hands-on experience. Phew! So we've seen all these traps. How on earth do we avoid them? Well, this quote from our source material just says it all. An investor without a strategy is like a rudderless boat. Think about that. Without a plan, you are just drifting, totally at the mercy of the unpredictable winds of the market. That rudder, that's the thing that gives you control and direction. And for an investor, that rudder is your strategy. It's your guiding star in the sometimes crazy world of finance.
So what do we even mean by strategy? Think of it like your financial GPS. It's not about planning every single turn you're going to take along the way. It's about the overall route that's going to get you to your destination. It's the big picture plan that answers the most important question. How am I actually going to reach my financial goals?
And let me tell you, having that map, having that powerful plan is a total and complete game changer.
A really solid strategy does 4 crucial things for you. First, it helps minimize your risk of losses. It gives you absolute clarity on your long-term goals. It actually opens you up to new opportunities you might have missed. And finally, it helps you use your time and money way more efficiently.
Okay, that all sounds great, doesn't it? But how do you actually build one? Let's get down to it and talk about crafting your own winning strategy. So, our source material boils it all down to 2 absolutely essential criteria for any good investment plan. Let's break them down into simple, doable steps.
It really is this simple. Step 1, make sure your strategy aligns with your goals. You have to ask yourself, why am I even investing in the first place? Are you saving for retirement in 30 years? Or maybe for a down payment in 3? Your vision determines the path. And step 2, be honest with yourself. Your strategy has to match the resources you have right now. And that's not just about money. We're talking your time, your knowledge, and your emotional ability to handle risk. A brilliant plan that you can't actually follow? Well, that's just a daydream.
So, here's the bottom line. The biggest variable in your investment success isn't the market. It's you. It's your psychology, your discipline, and your strategy. So with that in mind, I'm going to leave you with a question to think about. Your financial future is a blank page. What's your first move going to be? All right, let's talk about something I think we've all felt. You know that pit in your stomach when you're watching your stocks go up and then down? Yeah, this one's for you. We're going to break down a much calmer, way smarter way to track your investments so you can get off that daily roller coaster of panic.
I mean, it's a feeling every single investor has, especially when you're starting out, right? You pull up your app, you see that red arrow pointing down, and your brain just goes into overdrive. Should I sell? Oh no, did I just make a huge mistake? It's so stressful. But here's the thing. What if focusing on that price, that number that goes up and down, is actually the wrong thing to be watching?
See, the real key here is to just shift your focus. It's not about sticking your head in the sand and ignoring your investments. Not at all. It's about learning to watch the substance behind the stock, not just all that market noise. It's about changing what you're looking at.
Okay, so let's get into what I like to call the price watching problem. It's this super common trap we all fall into. You know, reacting to every single little tick up or down on the screen. And look, it feels like you're being a responsible investor, right? But honestly, for long-term investing, it's a totally flawed and super stressful way to go about it.
Think about it.
A stock's price can drop for a million different reasons. A scary headline pops up, the whole market takes a little dip, or maybe there's just some, I don't know, weird situation nobody understands. But, and this is a big but, none of that necessarily means the actual company is in trouble. Reacting to just the price is kind of like trying to judge an entire novel based on one single crumpled page. You're just not getting the whole story. So this all leads to a really crucial shift in how you think about this stuff. Instead of obsessing over the stock price, we need to start obsessing over the business, the actual company behind the stock. That right there is where smart, long-term investing really begins.
And this is it. If you take away only one thing today, let it be this quote. Focus on the performance of the business and not the stock price. Let that sink in. Because if the business itself is healthy, if it's growing, then you can reasonably expect it to do well in the future no matter what kind of temporary noise is happening in the market. This is your new guiding principle.
So you can really see the difference between these two mindsets, right? On one hand, you've got the reactive investor who's just strapped into this emotional roller coaster every single day, completely driven by those price changes. But on the other hand, the wise investor, they're looking at the engine of the company. Their decisions are way more informed, they're strategic, and honestly, they're just a whole lot less stressed out because they're basing their choices on the company's actual fundamental health.
Okay, so you're probably thinking, great, if I'm not supposed to be watching the price all day, what should I be watching? That is the perfect question. If we're going to tune out all that daily chatter, where do we point our attention instead? Well, it really boils down to two key areas. Two things that give you a real picture of how a company is doing. Let's break them down.
All right, first up, we've got to analyze the numbers. Yep, this means we have to become, well, kind of like financial detectives. We got to roll up our sleeves and actually look at the company's reports. Now, I know that sounds super intimidating, but trust me, you do not need to be some Wall Street genius to get the main idea.
Here's the difference. A stock chart tells you how people feel about a company on any given day. It's all about emotion. But the financial reports, they tell you how the company is actually doing. This is where you find the cold, hard facts, the real proof of whether the business is healthy and actually growing.
And you can start with just a few simple questions. First off, are sales growing? I mean, that's the engine of any business, right? Second, you want to ask, has the company taken on a whole bunch of new debt? Because too much debt can be really risky. And third, look to see if they've issued a ton of new shares. Why does that matter? Well, it can dilute your ownership, which basically means your slice of the pie just got smaller. Every one of these numbers tells a story. Okay, on to our second big area of focus. You have to assess the management. And believe me, this is just as important as the numbers. You can have a fantastic business, but if the leadership is bad, they can steer that ship right into an iceberg. Just think about it like this. You're not really just investing in a brand name or a product. You're investing in the team that runs the whole show. What they prioritize, the decisions they make, their vision for the future. All of that directly impacts how the company does. And of course, that impacts your investment.
So what are you actually looking for? Well, first, how do they talk about their shareholders? Are they respectful? Are they transparent? Second, and this is a simple but really powerful one, do they pay their dividends on time? That shows they're reliable. And finally, what's their main focus right now? Are they talking about long-term growth, or does it seem like they're just chasing the latest shiny object? These kinds of questions can tell you so much.
So let's just wrap this all up. When you focus on the real health of the business by looking at its numbers and checking out its management, you stop being a slave to the stock price. You actually align yourself with the company's real long-term potential. You go from being just a nervous spectator to being more like a partner in that company's journey. And that really brings us to the final and maybe most important question. Now that you have this new way of looking at things, how are you going to change your own strategy? Are you going to spend a little less time staring at that blinking stock ticker and maybe a little more time reading the company's annual report? It's a small shift, but it's one that can totally transform you from a stressed-out spectator into a really confident long-term investor.
You've probably heard the word bond thrown around on the news, right? It sounds kind of complicated, maybe a little intimidating, but what if I told you the basic idea is actually really, really simple? Well, it is, and we're going to break it all down. So, let me just ask you a question. Have you ever wished you could be the bank? You know, instead of always being the one paying interest, you could be the one collecting it? Well, believe it or not, that's exactly what you're doing when you buy a bond. You are literally lending your money out to a big organization.
You are the bank. And once you get that idea in your head, everything else about bonds starts to click into place. So for this first part, we're going to lean right into that idea. You are the bank. Because honestly, this one little metaphor is the key. It unlocks how every single bond works, no matter how simple or complex it seems. Okay, but there is one key difference from a loan you might be more familiar with, like a car loan. With your car loan, right, every single payment you make chips away at the original amount you borrowed. But with a bond, it's a little different. The borrower pays you only interest payments for years, and then, bam, on the very last day, you get your entire original loan amount back all at once. So if you're the bank, your next question is probably, all right, who am I lending my money to? I mean, who are these borrowers, and what do they need the cash for? Let's meet them.
It really boils down to two main groups. First, you've got governments. This could be anyone from your local city all the way up to the federal government. And second, you have corporations. We're talking about huge, well-known companies. Think Apple, think Ford.
And what in the world are they doing with your money? Well, a massive chunk goes into public works. We're talking about the roads you drive on, new schools, hospitals. Governments also use it to plug holes in their budgets. Corporations, they use it to fund new ideas and to grow. And throughout history, bonds have been one of the main ways countries have funded massive efforts, like going to war.
All right, any loan has some terms and conditions, and bonds are no different. There's a bit of jargon, but don't let it scare you off. It's really just the fine print on the loan agreement between you and the borrower. So let's decode the three big ones you absolutely need to know. First up is par value. This one's super easy. It's the price tag, the face value of the bond. If a bond has a par value of $1,000, it means you are lending the issuer $1,000. That's the principal they promise to give back to you. Next up, the maturity date. Think of this as the finish line. It's the exact date on the calendar when the loan is over and the borrower has to pay you back that par value in full. It's the end of the deal. And finally, we have the coupon rate. And this is the fun part. This is the interest you get paid for lending out your money. So if you have a $1,000 bond with a 5% coupon rate, that means they're going to pay you $50 a year, every year until that maturity date we just talked about. Simple, right? Okay, now think like a bank for a second. You wouldn't just lend your money to anybody off the street, would you? Of course not. You'd want to know how likely they are to actually pay you back. Well, in the bond world, that's called gauging the risk, and it's a huge deal. Bonds exist on this whole spectrum of risk. On the safe end, you have investment-grade bonds. These come from rock-solid companies and governments that almost never miss a payment. It's low risk, so you get a lower reward, less interest. On the other end of the spectrum, you have what are called junk bonds. These are from riskier outfits, and because there's a bigger chance they might not be able to pay you back, they have to tempt you with a much higher interest rate. More risk, more potential reward. Make sense? And if you want a perfect example of the super safe end of that spectrum, just listen to this phrase. U.S. Treasury bonds are considered one of the safest investments on the planet precisely because they are backed by the full faith and credit of the United States. That's a powerful promise. It means the entire U.S. government and its ability to tax is standing behind that loan. That's some serious security. Okay, this is where it gets really interesting. See, you don't actually have to hold on to your bond until it matures. You can sell your loan to somebody else, kind of like a used car market. But the price you get for it can change. And this leads to probably the single most important rule in all of bond investing. You ready? All right, scenario number 1. Let's say you buy a bond that pays you 4% interest. Pretty good. But then a month later, things change, and brand new bonds are being sold that pay 6% interest. So overall interest rates in the market have gone up. So what does this mean for your 4% bond? Well, think about it. Who in their right mind would buy your old 4% bond when they could just get a shiny new one that pays 6%? Your bond just became way less attractive. It's yesterday's news. So for anyone to even consider buying it from you, you've got to lower the price. You have to sell it for less than what you paid for it. Its market price goes down. This is called selling at a discount. So remember this. Interest rates went up and the price of your bond went down. Now let's flip the script. Let's say you buy a bond paying a nice 5% interest, but then, the economy slows down and new bonds are only paying 3%. Overall market interest rates have gone down. All of a sudden, what are you holding? you've got the golden ticket. You have a piece of paper that guarantees a 5% payout in a world where everyone else can only get 3%. Everybody wants your bond. It's suddenly the hottest thing on the market.
And what happens when something is in high demand? The price gets bid up, up, up. You can now sell that bond for more than you paid for it. That's called selling at a premium. So this time, interest rates went down and your bond's price went up. It's a seesaw. One goes up, the other goes down. That's the golden rule.
Okay, so let's just quickly recap the absolute must-knows. First, a bond is just a loan and you're the lender. Second, governments and big companies issue them to get cash. Third, they can give you a nice, steady income stream from those interest payments. And fourth, the big one, bond prices and interest rates move in opposite directions. Always. And that kind of leaves us with a final thought to chew on. You know, in a world where the stock market can feel like a total roller coaster, this predictable nature of bonds is why so many people value them. It's a source of stability. So the real question for you to think about is, in all that volatility, could bonds be the anchor that your portfolio has been missing?
Welcome to The Explainer. Today, we are peeling back the curtain on the high-stakes, high-hype world of initial public offerings. IPOs. It's a world that can create millionaires overnight, but it's also one where everyday investors can get really, really burned. So let's find out why.
And the source material for this whole explainer kicks things off with this pretty stark warning. It suggests that IPOs can be a game where regular investors, well, we end up holding the bag. So what exactly is an IPO and why does it come with this kind of reputation? Okay, so at its core, an IPO is just a company's big debut on the public market. It's a way for the founders and those early investors to cash out some of their stake, and it lets the company raise a ton of capital for expansion. But for you, it's the very first chance to buy a piece of that company. But listen, before you even think about jumping in on the next big name IPO, it is absolutely crucial that you understand the mechanics that make these brand new stocks so incredibly, well, volatile. The key to understanding all this wild price action really comes down to one big idea. It's called the small float. And what it means is that even for a huge company, the actual number of shares you can buy right after an IPO can be surprisingly, shockingly small. Let's just look at a real-world example here, Lyft. When they went public, a massive 88% of their shares were held by insiders, meaning they were not available for trading. Only that little 12% slice was the float. And with so few shares actually in play, it just doesn't take much to move the price.
Now, this small float, it's a real double-edged sword. With Lyft, a wave of sellers just completely overwhelmed the few buyers, and the price crashed. But then you look at PagerDuty. They had the exact same 12% float, but a surge of buyers sent the price soaring. You see, the small float just amplifies everything, for better or for worse.
So we've established that IPOs can be just nuts, right? Extremely volatile. Given those wild swings, how should you even begin to think about approaching them?
Well, according to our source, this is the most important question you have to answer first, because your entire strategy, everything you do, hinges on whether you plan to be a long-term investor or a short-term trader. Believe me, they are two completely different games.
So let's start with path number 1, the long-term investor. This is for the person who wants to buy a piece of what they believe is a great company and just hold on for years, maybe even decades. And the potential here, it's just mind-boggling. I mean, a single share of Coca-Cola from its IPO way back in 1919 could have made you a multimillionaire. But for every Coke, there's a Webvan, a super hyped company that goes straight to zero, taking all of your investment right along with it. But there's a major catch for today's long-term IPO investor. See, companies are now waiting way, way longer to go public. And that means a lot of that explosive early growth is happening while they're still private.
Just look at the difference between Amazon and Uber. Amazon went public after only 3 years, with a valuation under $500 million. That allowed public investors to ride its value up over 2,000 times. Uber, on the other hand, waited 10 years and went public at a massive $80 billion valuation. By then, most of that spectacular growth, it had already been captured by private investors.
Okay, so now let's look at that second path, the short-term trader. Now, this person doesn't see volatility as a risk to be avoided. They see it as the source of opportunity. So, the trader's approach is highly disciplined. It's not about the company's 20-year plan, it's all about short-term price action. They watch the stock's behavior, they check the market's pulse, and they look for something called a breakout. That's where the stock price just decisively moves above a recent high, and that's their signal to jump in. But most importantly, they always have an exit plan, a stop loss, to cut any losses quickly. Now, for anyone on this trader's path, there is one date that you should circle in bright red on your calendar. It marks a very predictable event that can dramatically shift the supply and demand for an IPO stock. 180 days. That is the typical length of an IPO lockup period. And what that means is for the first 6 months after a company goes public, insiders, we're talking the founders, the executives, the early venture capitalists, they are legally forbidden from selling their shares. So, the billion-dollar question for a trader is this. What happens on day 181 when that lockup finally expires and all those insiders are suddenly free to sell millions upon millions of shares on the open market? Well, it really just comes down to basic supply and demand. A huge increase in the supply of available shares can cause the price to drop. Now, this doesn't automatically mean the insiders are losing faith, right? They might just be diversifying their own wealth or cashing in after years of hard work. But regardless of the reason, that potential flood of new sellers creates a predictable event a savvy trader might just use to their advantage. And that brings us right back to where we started. Whether you're trying to find the next Coca-Cola or just trade a short-term swing, navigating the world of IPOs requires a really clear strategy. So the question is, are you the investor, the trader, or are you the dumb money? Hey, welcome. Today, we're going to dive into a really powerful strategy for getting paid directly from the stock market. It's called dividend investing. And honestly, it's a method that can turn your portfolio into an income-generating machine. So let's break down exactly how it all works. But let's start with a really simple question. What if you could get paid, I'm talking real cash, just for owning a tiny piece of a company? You don't have to sell anything, no complex trading, just a regular payment for being an owner. That's the big idea we're digging into today. And that simple idea has a name, dividend investing. It's a strategy where you kind of shift your focus. See, instead of only hoping a stock's price shoots up, you're buying into companies that actually share their profits with you. They do this through regular cash payments called dividends. And the main goal? Well, it's to build a reliable, steady stream of passive income. Now, that all sounds pretty great, right? But I know what some of you are probably thinking. The whole idea seems almost a little too good to be true, and a lot of folks have their doubts. You've probably heard something just like this before. It's a really common point of skepticism. If dividends don't directly make the stock price jump, do they really add any value at all? It's a totally fair question, and it keeps a lot of potential investors on the fence. So, that brings us to the big question, the crucial point. When you zoom out and look at the big picture, the total return on your investment over years, even decades, do these little payments actually make a real difference? Well, the answer is a huge, resounding yes. And you don't have to take my word for it. The data proves it. Just look at this chart. It breaks down the total return of the S&P 500 for nearly a century. I mean, check out the 1970s. A staggering 72% of the market's total return came from dividends. That's wild. Even across the entire 86-year period, they were a massive part of performance. The takeaway here is undeniable. Dividends don't just matter, they are an absolutely critical piece of long-term returns. Okay, so we've seen that dividends are a huge part of the equation. Now, let's zoom in on their number one benefit, building a truly powerful income stream. I love this phrase, you get paid to wait. Think about it. While you're holding onto your shares, letting them grow in value for the long haul, the company is literally sending you cash. It's a steady, reliable source of passive income that just shows up without you having to lift a finger. And this is a fundamental difference that you've got to understand. With most stocks, the only way to realize your profit is to sell your shares, right? You give up your ownership. But with dividend stocks, the company sends you your cut of the profits in cash, and you get to keep all of your shares. You get the cash, and you stay an owner. It's the best of both worlds. So imagine that stream of payments growing over the years. This isn't just pocket change we're talking about. It can become a really substantial income stream that could help fund your retirement, cover unexpected bills, or just build your wealth, all without ever having to sell the very assets that are generating it. But dividend investing is about more than just income. It's also a strategy. It can act as a kind of financial shield, giving you a layer of defense against some of the market's biggest challenges. Specifically, dividend stocks can help protect you against 3 major financial headwinds: rising inflation, those scary market downturns like bear markets and corrections, and even taxes. Let's break down each one. First up, inflation. When the cost of milk, gas, everything is going up, your money just doesn't buy as much. But here's the thing. Many of these stable dividend-paying companies have a long history of increasing their dividend payments over time. This can help your passive income grow right along with, or sometimes even faster than, inflation. Okay, next, bear markets. When stock prices are falling off a cliff, it's pretty easy to panic. But dividend investors have a secret weapon. Even when the market is tanking, that cash just keeps flowing in. And that gives you fresh capital to buy more shares while they're basically on sale, which can set you up for much bigger gains when the market eventually turns around. And finally, let's talk taxes. This is a super important detail that a lot of people miss. See, not all dividends are created equal in the eyes of the taxman. Qualified dividends, which usually come from stocks you've held for a little while, get taxed at a much lower rate. Compare that to non-qualified dividends, which get taxed at your normal, higher income tax rate. This means with qualified dividends, you just get to keep more of your money. It's a really smart, tax-efficient way to build wealth. So we've talked about income, and we've talked about defense, but there's one more piece to this puzzle. And honestly, it's the most powerful concept of them all. It's how you can take everything we've just discussed and multiply its effect. I like to call it the compounding snowball. The real magic happens when you choose to reinvest those dividends. And it's a beautifully simple process. Step 1, the company pays you a dividend. Step 2, you use that cash to automatically buy more shares of that same company. So now, you own more of the company, which means, you guessed it, your next dividend payment is even bigger. You just repeat that over and over, and your investment starts to snowball, growing bigger and bigger, faster and faster over time. That one simple act, reinvesting, it just multiplies the effect of your original investment. It is the engine that can seriously turbocharge your wealth creation, turning a simple income stream into an asset that grows exponentially. And that really brings us to the ultimate takeaway here. With dividend investing, the goal isn't just about earning a little extra income today. It's about systematically building an asset that pays you more and more and more over time. So the real question isn't just about what you can earn. It's about what kind of income-generating machine could you build for your future. So you're getting into investing. That's awesome. But let's talk about some of the classic traps that so many people fall into. I'm talking the real portfolio killers that can stop you dead in your tracks. In this explainer, we're not just going to list the biggest mistakes. Nope. We're going to show you exactly how to see them coming and, more importantly, how to dodge them. First things first, let's get one thing straight. You are going to make mistakes. It's just part of the journey. As our source points out, even the pros mess up sometimes. That's actually how you learn. So the goal isn't to be perfect, it's to be smart and prepared. But here's the real question, right? What's the difference between a simple learning experience and a mistake that could totally wreck your portfolio? Well, that's what we're here to figure out. We're going to walk through these common pitfalls so you can spot them, sidestep them, and build a way stronger foundation for your future. So where do we start? Not with stock charts or fancy algorithms. We start inside your own head. Because the very first battle you have to win as an investor, well, it's the inner game. So let's dive into the biggest mindset traps to avoid. And what's the number one enemy in that inner game? It's you. It's your own emotions. You know that thrill when a stock is soaring, or that pure panic when the market takes a nosedive? Those feelings have a really nasty habit of hijacking your decisions and making you see danger where there isn't any. This right here shows the two paths you can take. On one side, you've got decisions driven by fear, by hype, by gut feelings. And on the other, you have decisions driven by cold, hard logic. A smart investor knows they're going to be wrong sometimes, and they actually plan for it. They separate their feelings from the facts, and that is the key to winning in the long run. You know, this emotional thinking creates a whole minefield of traps. You've got people chasing that get-rich-quick fantasy, or being so impatient they pull their money out before it has a chance to grow. Then there's falling in love with a single company or blindly following some guru without understanding why they're making those moves. But maybe the worst one of all, trying to get even after a loss. That almost always just digs a deeper hole. And the solution is right here. In this classic story we all know, the stock market isn't a sprint. It really is a race between the tortoise and the hare. Slow, steady, and patient investing, that's what builds real wealth. The second you stop chasing a get-rich-quick scheme is the moment you actually start building a fortune.
All right, so you've got your mindset in check. Awesome. But a strong mindset without a solid plan is like a race car with no steering wheel. You're just going to crash. That brings us to our next section, fatal flaws in strategy, and how you can build a blueprint that actually gets you where you want to go. So what's the single biggest mistake when it comes to strategy? It's shockingly simple, having no plan at all, just guessing. As the source material says, guesswork leads to damages. Without a plan, you're basically flying blind, and that's a good way to get hurt financially. And here's the other part. Once you have a plan, you've got to stick to it.
So what does a basic plan even look like? Don't worry, it doesn't have to be some super complicated document. At a bare minimum, you need to figure out 3 things before you ever click buy. Number 1, what's your entry point? At what price are you getting in? 2, what's your exit strategy? When are you going to sell for a profit or to cut your losses? And 3, what's your capital limit? How much are you willing to put on this one single trade? Another fatal flaw? Putting all your eggs in one basket. This is what happens when you fall in love with a company's story. Our source calls these investors fanboys, and you just pour all your money into that one thing. The smart move is diversification. Spreading your investments around is like a safety net. It protects you if one company, or heck, even a whole industry, takes a nosedive.
And here's a huge question you have to ask yourself. Are you investing because the company has solid long-term fundamentals, or are you just jumping on the bandwagon because it's been getting a lot of hype lately? Remember, a company's hot streak can cool off fast. Investing in hype without understanding the actual business is just a recipe for disaster.
All right, so we've covered mindset and strategy. Now let's talk about where the rubber meets the road. Execution. These are the action-based errors people make when they're in the heat of the moment, when their actual money is on the line.
A classic mistake is thinking you can outsmart the market by trading constantly. It's called overtrading. Day traders are the most extreme example, but honestly, the data shows that all that frantic buying and selling just racks up fees and often leads to lower returns than a simple buy and hold strategy. Sometimes the best move you can make is no move at all. And now for what might be the single most important rule in all of investing. I mean it. Never, ever invest more money than you can truly afford to lose. There are no sure things in the market. Luck is always a factor. If you ignore this rule, it's not a question of if you'll learn this lesson the hard way, but when. And beyond that, you've got to watch out for these other common slip-ups. Are you getting that go big or go home feeling? Are you holding on to a losing stock just hoping it'll magically turn around? Did you even research the broker you're trusting with your cash? And are you still trying to perfectly time the market? All of these are just different ways to lose money. So if you're not supposed to time the market, what do you do? Well, our source points to a really powerful strategy called dollar cost averaging. Instead of trying to guess the absolute best time to buy, you just invest a fixed amount of money on a regular schedule, say every 2 weeks. This automates everything. You end up buying more shares when prices are low and fewer when they're high. But its real magic is psychological. It takes the emotion out of it and forces you to be disciplined for the long haul. So after looking at all these potential mistakes in your mindset, your strategy, your actions, what's the big takeaway? The source material gives us a fantastic analogy for this. To succeed, you have to become the patient gardener. Just think about it for a second. You wouldn't plant a seed and then get mad at it the next day because it's not a full-grown tomato plant, right? Investing is exactly the same. The first few years, you might not see much growth, but if you're patient and you keep tending to it, your investments will compound and start to grow faster and faster. Expecting huge results overnight? That's a fool's game. And that leaves us with this final crucial piece of wisdom. Your goal shouldn't be to get rich fast. It should be to get rich for sure. By avoiding these common mistakes, by getting your head right, building a solid plan, and acting with discipline, you're trading a lottery ticket for a blueprint. And that, my friends, is how real, lasting wealth is actually built. Welcome to The Explainer. Have you ever wondered why some people seem to make a fortune in the stock market while so many others just lose? Well, today, we're going to unlock the secrets of successful trading. This is your quick guide to joining the winning side. Okay, let's just get real for a second. Trading can be a pretty brutal game. The numbers, well, they really don't lie. A staggering 80% of new traders crash and burn. I mean, they get completely wiped out, and those dreams of financial freedom, they just turn to dust. It's kind of the harsh reality of the game. But here's the thing. That 80%, that doesn't have to be you. You're here because you want to learn, you want to grow, and you want to become part of that elite 20%. And I'm going to show you exactly how. It really all starts with a simple shift in how you think. So think of this as your battle plan. We're going to cover 4 key areas. First, we'll build your trader's mindset. Then we'll help you master the market's language. After that, we'll talk about executing your strategic edge. And finally, how to commit to the long game. By the end of this, you're going to be trading with the confidence of a pro. First things first, we absolutely need to talk about what's going on between your ears. You know, in trading, your mind is your greatest asset, but it can also be your worst enemy. So let's start by building a rock-solid foundation for success. So forget all the fancy algorithms and the hot stock tips for a minute. The real holy grail of trading is actually something way simpler, but also way more powerful: a written trading plan. This thing is your personal rulebook, your North Star in the sometimes chaotic world of the market. Look at it this way. Without a plan, you're basically just a gambler, throwing money at the market and just hoping for the best. But with a plan, you become a CEO. You're making calculated, objective decisions based on logic, not on fear or greed. You'll know exactly when to get in, when to get out, and how to protect your capital no matter what the market decides to throw at you. And this right here, this is non-negotiable. Trading is not a hobby. It's a high-stakes business, and you have got to treat it that way. That means you're showing up every day, you're doing your homework, you're managing your risk, and you're ready for the challenges that will come. If you're not willing to put in that work, you're pretty much just donating your money to the professionals.
Now, let's get a little personal. Why are you even here? What do you really want to achieve with trading? Is it about financial freedom, a better life for your family, or maybe just the thrill of the game? Whatever your why is, I want you to write it down. Put it somewhere you can see it every single day. Because when the market gets tough, and believe me, it will, your why is going to be the fuel that keeps you going.
All right, so your mind is sharp, you're ready to play the game. Now it's time to actually learn the rules. Welcome to the language of the market. This is where we give you the knowledge you absolutely need to compete with the pros. There are 2 main ways people pick stocks. You can be a detective, which is like fundamental analysis. You're investigating a company's financial health. Or you can be more of a psychologist, which is like technical analysis, reading the emotions of the market through its charts. The most successful traders, they usually use a little bit of both.
So let's talk about a super powerful tool for fundamental analysis, the P/E ratio. The easiest way to think about it is like a price tag for a stock. It tells you how much you're paying for every single dollar of the company's earnings. A really low PE might mean you found a bargain, while a really high one could be a red flag.
Okay, next up is return on equity, or ROE. This is basically a report card for a company's management. It shows you how good they are at turning your investment into cold, hard cash. Simple enough, the higher the ROE, the better the grade.
So now that you have an idea of what to buy, you need to know how to buy it. And that's where order types come in. A market order is like shouting, "Get me in now, I don't care about the price." A limit order is more cautious. It says, "I'll only buy at this price or better." And then a stop order is your safety net, getting you out of a trade if things go south. Mastering these is just crucial for controlling your risk.
You've heard that old saying, right? Don't put all your eggs in one basket. Well, in trading, that is the golden rule. Seriously, if you bet the farm on one stock and that company tanks, you're toast. But if you spread your money out across different companies, different industries, even different countries, you can weather almost any storm. That's the real power of diversification. Okay, you've got the mindset of a champion, the knowledge of a scholar. Now it's time to actually step into the arena and execute your strategy. This is where the rubber really meets the road. In today's market, you're not just up against other traders, you're competing with supercomputers. So to level the playing field, you have to embrace technology. I'm talking about using powerful charting software to spot trends, backtesting your ideas against historical data to see if they actually work, and setting up alerts on your phone so you never ever miss a move. Want to know when the market might be about to go a little crazy? Just look at the economic calendar. Big announcements like interest rate decisions or inflation reports are like bombshells that can send shockwaves through the entire market. If you're prepared for them, you can ride those waves to huge profits. If you're not, well, you could get crushed. Now it's time to choose your weapon. Are you a fast and furious day trader, living and breathing the market every second of the day? Or are you more of a patient sniper, a long-term trader waiting for that perfect opportunity? There's no right or wrong answer here, but you have to choose a style that actually fits your personality and your schedule.
And once you've figured out your style, then you need to pick your broker. A day trader, for instance, needs a broker with lightning-fast execution and super low commissions. A long-term investor, on the other hand, needs one with a huge selection of assets and low fees. So do your research and find a broker that's a perfect match for you. We've covered mindset, we've covered knowledge, and we've covered execution. But there's one more ingredient to the secret sauce of success, and honestly, it might be the most important one of all: persistence. This is what separates the winners from the losers, the pros from the amateurs.
I want you to read these words and just let them sink in for a second. Patience will definitely pay you off in the long run. Trading is a marathon, it is not a sprint. There are going to be times you want to quit, times you feel like you'll never make it. But if you can just hang in there, if you can stay patient and keep learning, you will succeed. I promise you.
Losses are not failures. You have to think of them as tuition. Every single time you lose, you're paying for a valuable lesson. The key is to actually learn from those lessons, to figure out what went wrong and how you can do it better next time. The traders who do that, they're the ones who ultimately make it. So, there you have it. You now have the map to the treasure. You've got the tools, you've got the knowledge, and you have the mindset to become a successful trader. The only thing left to do is to take that first step. So what are you waiting for? The journey to the 20% starts right now.
All right, so you've done the homework. You know the lingo, you've got the concepts down, but now for the really important part, turning all that knowledge into action. So let's talk about how you take those very first steps toward becoming a successful investor.
So, you've learned all the theory. But what's the one thing, the single most important part of investing that really separates the pros from the amateurs? I'll give you a hint. It's not about some secret formula or being able to predict the future. Nope, it's something much more fundamental. And here it is. You have to treat investing as a skill. Seriously, think about it like learning to play the guitar or getting good at a new sport. It's a craft that you have to build over time. It takes patience, it takes effort, and, most importantly, it takes practice. You can't just read a book about it, you've got to actually do it. And the parallels here aren't, well, they're pretty striking, right? You would never expect to become a concert pianist after just one lesson. And it's the exact same thing with investing. Both have a learning curve, for sure. Both demand consistent practice. And both will absolutely punish you if you try to rush the process. But if you stick with it, the long-term rewards, well, they can be totally life-changing. You've got to accept this right from the start. You are going to face challenges. Your first couple of moves, they might not be home runs, and that is completely okay. It's normal. I mean, even the most legendary investors in the world had huge setbacks. The trick is to see those moments not as failures, but think of them like tuition you pay for your education in the market. Just persevere, and I promise you'll come out so much stronger. And this whole idea of perseverance, it leads us right into the next crucial piece of the puzzle. See, mastering the skill of investing isn't just about reading charts and crunching numbers. As this quote says, so much of the game is played right here, in your head. It's all about managing your emotions when your own money is on the line. This is exactly why you have to build up your own psychological toolkit. You need that resilience to handle losses without freaking out. You need real, sheer positivity to see the big picture. You need confidence in the strategy you've built. And you've got to have a clear sense of purpose, your why, that keeps you grounded when things get a little turbulent. And you know what? This toolkit is going to look different for everyone. It has to be unique to you. How much risk can you handle? How patient are you, really? All of these little personality traits are going to, and they should, shape the strategy you create. There is no one-size-fits-all plan here. True success comes from really knowing yourself and then building a system that actually works for you. Okay, so we've got the internal mindset down. Now, let's talk about the external framework. The absolute best way to approach the market is to stop thinking like a gambler and start thinking like a CEO. You have to run your investing like a serious business. So
what does that actually look like? Well, a good business doesn't run on hunches and guesswork, right? It creates a plan. It doesn't pretend risks don't exist. It assesses them and figures out how to manage them. It doesn't change its entire strategy every single day. It commits to its plan. And it operates with confidence, all driven by that clear purpose we were just talking about.
And let's be super clear about something. You cannot get rid of risk. It's impossible. In business and in investing, risk is where the opportunity comes from. So the goal isn't to avoid risk, it's to understand it, manage it, and make smart, calculated decisions. Being afraid of risk just leads to doing nothing. But understanding risk, that leads to smart action. And here's the great news. Your ability to handle that risk isn't set in stone. Think of your risk tolerance like a muscle. The more you use it by facing small, manageable risks and seeing how it turns out, the stronger that muscle gets. Something that feels really scary today will feel way more manageable after you've got a little experience under your belt.
Okay, so we've got the mindset, we've got the business framework. Now for the really fun part, your actionable roadmap. How do you actually go from all this theory to making your very first trade?
Here is your 3-step launch sequence. Step 1, use a stock market simulator. It's basically like a flight simulator for investors. You get to practice your strategies, make mistakes, and learn, all without any real-world financial consequences. It's a game changer. Once you're feeling good about that, step 2 is to open a brokerage account. And finally, step 3, take the leap and enter your first real position. Start small, but you have to start.
So we've covered the mindset, the strategy, the action steps, the whole shebang. But before we wrap up, let's just zoom out one more time and connect all this back to the most important thing of all, your motivation. Why are you even putting in all this effort to learn this new skill? Because ultimately, you can't lose sight of your why. Maybe for you, it's about achieving real financial freedom. Or maybe it's just about building another income stream or being your own boss. Whatever it is, these are the powerful goals that make the entire learning curve totally worth it.
Look, we've established that investing is a learnable skill, not some magical talent you're born with. Anyone can build it with a little time and effort. So the only question left is the one right there on the screen. What is your first practice session going to look like? Are you going to go download a simulator tonight? Start researching your first stock? The journey really does start now.
The road ahead is going to have its ups and downs, for sure. But by treating this as a skill you're developing, you are setting yourself up for success from day one. So with that, happy investing.